Inflation flares up again and gets really problematic, it could send gold back down, silver back down for some time. And I know that sometimes people say, oh, inflation, it's an inflation hedge. Well, not exactly correlated to inflation, or inversely correlated, I should say. If inflation goes up, what it causes a lot of central banks to do is to slow their rate cuts or even start hiking rates. That sends precious metals back down, right? Now, from a big picture, high levels of inflation over suspended period of time does cause precious metals to go up, just because everything goes up relative to weakening fiat currency. So I think, precious metals have room to go. I need to speed up my process here, so I'm going to keep going. We've already talked about stocks quite a bit here. We hit 3 years old in the 2020, 2025 era for this stock market rally. Do I think it can keep going? Well, the average is 5. So I would say yes. I think that the stock market can keep going. I think the Fed's going to keep cutting interest rates overall. I think the economy, although bifurcated, and you have wealthy people doing well, poor people, not poor people, but the lower end of the consumer, the poorer side of the spectrum, not doing nearly as well. Housing's in a problem. I understand there's many recessionary problems out there that are mixed into this, but I think you can have this weird bull market where the wealthy continue to get wealthier component, like we saw in the 1920s. So again, do I think it's necessarily healthy that we have a K-shaped economy? No. But I would say that the stock market can continue with this AI hype for a while. One of the big iconic things, and I'll be curious to hear if Chris talks about this, one of the big kind of under talked about things, I don't know, maybe talked about fairly, OpenAI going public could be sort of an event to watch very closely in 2026. It's a private company that is ginormous. Some people have said it's going to IPO at half a trillion. Some people say it's going to IPO at $1 trillion. It's a huge speculative event in 2026. And I think that you could have people who buy the rumor, sell the fact on that kind of thing. So these, and then you also have the tariff coupons, right? $2,000 to a bunch of Americans. What happened to that in 2020, 2021? Well, speculative frenzy. People bought crypto, NFTs, they bought stocks, penny stocks, everything ripped straight up. And we know how it ended. 2022 was an ugly bear market, down 30% for the NASDAQ or something like that. Or maybe it was the S&P, 35% for NASDAQ, something like that, 37, something in that neighborhood. It was rough. Okay. So I think you could have the melt up end out. Another thing you will likely hear from Chris in his segment, which is after mine, is this concept of investor sentiment still being pessimistic. Now, I'll reiterate that I don't think you're likely to have straight up market moves all through 2026. I think we've had a very low vol 2025, but I think you could get more of a 2018 type of environment in 2026. That would be my opinion. My opinion is a little bit more volatility. Maybe the bulls don't go unchecked all year long. Maybe you get some back and forth sentiment. The crowd is still a little bit pessimistic. You have some big key events. You have an administration that will do anything to push the stock market higher because it's his personal scorecard. That's a tailwind. Whether you like Trump or not, that's a tailwind, right? Because he's going to do whatever it takes to backstop the stock market and keep it moving higher. So I think that can go on for longer than some people may think. And that's why I'm not willing to bet against this market. Now, like I said, 2018, the reference that I made, anyone can pull it up on their own charts. 2018 was it was preceded by a very low vol year, like we've kind of had this year, right? So if we go back 2017 was low vol as anything. Look at this chart. This is the dream like index fund investors. This is your dream right there. Then what happened in 2018? Market had a little bit more chop to it, a little bit more ugliness. And this was arguably more of a trader's market because a trader can get in there, take some profits off, trail stops, sell premium if you're a Chris Pulver of the world, right? If you're in the option selling, like you can play this kind of market and do better than the average, right? Very hard to outperform a market that just goes straight up. So I think you could enter into a 2018. We've had a very low vol year in 2025 outside of the big April move that I think could resolve into something a little bit more volatile in 2018 was not a great year, but it followed was a really nice year in 2019. So you could get, in my personal view, some dips in 2026, but I think those dips will be bought. That would be my summary of the stock market outlook for end of year or end of year into 2026. Gold and silver, we already talked about that. I think there's upside. I wouldn't say I like gold and silver better than stocks. I would say that I think gold and silver have upside just following the momentum of the last few years. And I think that, if you get some downside in the meantime, that makes it even more attractive. If you get some gold and silver pullbacks to the 100, 200-day moving average, those start to be places where I'd look at some longer term buys on that. US dollar, I'm going to say that I'm very, very much thinking that the US dollar is neutral for now, but I think bigger picture, it has upside. Part of the reason, if you look at the nominal statistics of the US versus other places, it paints a very strong story for the US dollar. Okay. Really simple. Let's look at some of the big economic features. Okay. GDP growth in the US is at 3.8%. Compare that to the UK. UK is pretty much nothing. Look at Europe. Europe is very low. Look at Japan. Not very great. Okay. So growth in the US economy looks superior. What about interest rates, right? Interest rates play a big thing in currencies. Relative interest rates and real yield on interest rates looks very attractive. What's real yield? Interest rates minus inflation. Documented. I did some studies on this weekend, preparing for this presentation. Real yield, look into it. My currency trading friends, look into real yield. It's interest rates essentially minus inflation expectations. It shows you, and there's some really well done reported studies on outperformance in the currency market following real yield. Hint, Edgefinder users, it's coming to an Edgefinder near you. We're going to automate that full process and build out some really cool tools to help you track real yield. If you're a currency trader, currency traders are getting some love in 2026 from the Edgefinder because I've got some really cool stuff. We worked on it this weekend. We got new projects coming your way. Edgefinder is going to be leveling up big time in 2026. And anyways, if we look at the US versus other places, UK has similar, but they have higher inflation, right? So this is where you want to be careful. Oh, well, UK has similar interest rates. So maybe, pound dollar, real yield. Why do I care so much about real yield? Well, because if they have similar interest rates, but inflation in the UK, US is 3, UK is almost 4. That actually makes the dollar look relatively stronger because the purchasing power of the British pound is losing value quicker. See? That's what I'm talking about. We're going to build some tools to automate everything I just talked about because that is so critical. If you're a currency trader, especially if you trade daily, weekly timeframes, if you're looking at bigger picture moves, currency traders, stay tuned. I'm very excited for those new features. Euro, I'm not going to lie. I don't really have a really strong opinion on the euro, but just taking a quick look at the economic heat map for euro, got a bit of a mixed picture here. So I don't really have a strong forecast on that. I'm just going to go ahead and jump to pound because I know we're about to talk about it. Similar, although again, versus the dollar, I think dollar has upside in, I want to kind of pose this as high inflation, low growth from a bigger picture that makes the pound and the euro not particularly attractive. Although the euro, bigger picture, less inflation. So if I had to point a direction for euro versus pound, it would be higher maybe in next year. So we'll see. Japan, this is why I still think the yen, personally, I think it can remain weak for a while. The new prime minister is a dove. She wants to keep interest rates lower. That's part of it. But look at inflation, 2.9% and negative growth. That makes the yen to me look like a very opportune thing for the carry trade. I mentioned and teased this earlier, so let me finish on this topic because I'm running out of time. The yen is key, critical for 2026. Okay. Dovish prime minister, higher inflation, but unwillingness to hike interest rates and low growth makes the yen look weak, which I think will invite the carry trade to stay alive for a little while. If that is the case, that is a tailwind to risk assets. If there's borrowing from the Japanese yen to be pumped into other places, right? If that trade is going to stay alive and well, as opposed to a really strengthening Japanese yen, which can threaten that story, right? It can go the other way. People buy back their Japanese yen shorts and deleverage a little bit, right? Leverage is good for stocks to go higher and higher and, melt up into the sunset. Unwind of that is the opposite effect. So watch the Japanese yen in 2026. It is really critical. It is a key currency to watch, I think, in 2026, because if that story stays intact, the bull market is supported by leverage, right? The global leverage provider, the Bank of Japan. Watch the Japanese yen and the dollar, but the Japanese yen is critical for that specific, the carry trade. I know we talked about a million things during my segment here, and I hope that you take a chance to listen back to the webinar recording. It will be sent to your email. Watch it back, go through some of these things, because I know like carry trade, yen carry trade, I know some of you guys are like, what the heck is that? I could spend 20 minutes talking about it. I've done that. So go watch the videos, go search up the yen carry trade, ask your AI about it, watch it on my YouTube channel, whatever. Be aware of the yen carry trade in 2026. It is very critical to leverage or lack thereof in the financial markets. So with that said, we're going to throw over the show here in just a second to Chris Pulver to continue our webinar presentations. Before we move on, let me just remind you that for people who are with us here live, we're going to be doing 45% off. It is our biggest discount that we do all year long on our products and tools. If this has been helpful to you, if you want to take your trading to the next level, I hope that you'll consider picking up a copy of the Edge Finder. Genuinely, it is a passion project that I've worked on since 2021. We also have the stock box, which is a huge, new feature that we've added, or a bunch of new features we've added recently to that. If you don't have Stockbox, if you don't have Edge Finder, and if you don't have our VIP group, I hope that you'll consider joining us during this Black Friday discount. Everything that you need for information on that can be found sending us a direct message using this link right here. If you click that link, it'll connect you to a real person on my staff who's standing by to get you set up with our lowest prices of the year. If you need to split this into 2 to 3 payments, this is a way to get everything at 45% off, and the support staff can split it up into 2 or 3 payments if that is more accessible to you. We're trying to make it as accessible as possible. These things are not cheap to build or to maintain. We have a staff behind the scenes. There's a lot of stuff that goes into building and maintaining the stuff. So we're doing our best to make it as accessible to people as possible. If you want access to Edge Finder, if you want access to our VIP group, if you want access to Stockbox, which is our product for stock market scanning, all of that can be found on our website, a1trading.com, or you can click the link here and speak directly to a member of our support staff. Edge Finder is the best tool in Forex. I appreciate it. Just you wait, man. It is about to explode. Edge Finder is in 2026. If I had to take one trade for 2026, it would be long Edge Finder, because this thing is going to the moon, baby. I'm telling you, like, we got so many cool features. I'm so excited to share them with you. I teased it a little bit, but we have some real yield tools that are coming out for longer term currency trading, analyzing. I'm very, very excited for that. As with currencies, I'm a little bit longer term in nature. So we've had that heavily requested by a few of our lead traders. Specifically, Marco's been asking for that. I can't wait to share it with you guys. 2026 is going to be great. I hope that you'll join us, get the tools, join the VIP. I know it's everybody wants things for free, but I'm telling you, it is worth every penny, especially if you see yourself being here for 5-10 years. Get access to the Pulver alerts. Our products are one-time payments. So if you're someone who's going to trade for 5-10 years from now, it's worth every penny. 5-10 years from now, the same prices, who knows, it might not even be able to buy you a loaf of bread because stuff's getting more expensive. So buy it now before the price goes up, before, the sale is over. So there you go. With that said, guys, up next, I'm going to back out here. I'll just, I'll stay in for just a second and welcome in Chris Pulver if we want to just, thank you, Jim. What's up, Chris?
What up, Nick? Happy Monday, man.
Happy Monday. It's good. I was saying at the start of my thing here, it feels like just yesterday we did this for 2025.
Yeah, it's amazing how fast this year actually went by. It's like we have Thanksgiving next week. It's already like holiday time.
I know.
It really has flown by. Like it's been like honestly, April When I saw you in the office in April, it seems like light years ago.
I know. What are you cooking me for Thanksgiving? I'm coming over. You got a seat at the table?
You a fan of tofurkey?
Yeah, that sounds great.
Nice. Yeah, no, we're doing like a Friendsgiving here.
Cool.
And then we'll have we got some travel plans for the holidays. But yeah, man, same thing to you guys in the office. And I hate to say this, but I might not be able to come see you guys next year.
Oh, really?
Because we have a due date for baby number 2.
Wow, look at
Yeah,
you
kind of
guys.
big news.
That's the
So
real announcement here today.
yeah.
That's what this
So
workshop is.
it's like we're due like mid-April, so it's kind of right around that Augusta season, So anyway,
Well, very cool.
if it works out, well,
Congratulations.
I'll be there. But that's kind of a
That's
top
more
priority for
important anyways,
2026.
Chris. We'll be cheering you on from here. Well, Chris, I'm gonna give you your time here. You got your hour to go through whatever you'd like to talk about.
Perfect.
And however you want to approach it. Also, someone asked in the chat if they can do a certain amount for Edgefinder. Just shoot us a message. Again, it's the easiest way. We'll drop the link one last time. If you want Pulver alerts, Edgefinder, whatever, just shoot us a message. We can set you up with a payment plan. We have extra discounts for people in places where the dollar is very expensive. Whatever you need, just shoot us a message, and someone from our helpful staff can get you situated. Chris, you got it from here, man. Enjoy it, and thanks for doing it.
For sure. Thanks, Nick.
All right, see ya.
Bye. All right, everybody. Been looking forward to this session for a long time. We've been working on this behind the scenes for the last month or so, and what a wild ride 25 has been. Looking forward to 2026. How many of us are? Give me some feedback in the chat. How many of us are actually excited for 2026? Who's like? Just be honest. Are we nervous? Are we uncertain? Are we ready to make 2026 our best year yet? Like that's kind of been my mantra for trading. Is like figure it out. Best year yet. 2025. We had a scare, and I think now the market. It seems, it feels, it's all been about like sentiment. 2025. I think that's been the biggest disconnect between what the market's actually doing and what everyone feels out there. Like the economy feels fragile. The economy feels right. It's like this K-shaped recovery. It feels, but it's not what actually is being reflected in the price action. So, we had a legitimate scare in March and April. The market rotated pretty hard. We saw some pretty nasty volatility, but you really saw the true. You saw the true side of like there is a backstop in these financial markets, and I think that the reality is it is very difficult for the U.S. to accept a recession is on the horizon, and there are a lot of tools and resources to implement to prevent that from happening. This, I want to talk a little bit about, so where the secret to me is like, where is the money going? Liquidity is ultimately what's going to drive asset prices. Yes, we could have an uptick in inflation. Okay. We could have the Feds cutting rates. Okay. We could have the Feds pausing. We could have, Trump and company that we're talking about cutting spending, still spending. We could have the Fed, which is, ending QT and possibly rolling out QE in 2026. So my mantra for 2026 is follow the money. Liquidity is going to be pretty plentiful, and it's not just on the U.S. side, but it's globally. China is still spending money. U.S. is spending money. Eurozone is spending money. Countries around the world are adding, fiscal policy and spending. And I think, therefore, that liquidity, the increase in global money supply, will also be a bit of a support level. I'm not going to say a huge tailwind, but I'm going to say a nice buffer to keep just the kind of complacency and assets where they will stay in this amazing phenomenon called positive drift. So, unfortunately, I think that the tail risk of the left side and the right side are equally scary. Like we could have a 10-15% correction, 10-15-20% correction that doesn't necessarily derail a bull market. And I think on the upside, we could probably have more upside risk than people expect. And all of a sudden you want to talk about, oh my gosh, this is a bubble. I think that right now this whole talk of a bubble is nonsense, because I don't think you have any idea what a bubble looks like. And I heard an interesting segment this weekend. If 2000 never happened, if 1999, 2000 never happened, we'd have no reference point to say like this is a bubble. I do think that the companies that are leading the way are financially some of the wealthiest, biggest companies in the world, and have been. I mean, if it wasn't for them, if it wasn't for the Mag 7, it wouldn't have shaped the economy like it has the last 10 years. The U.S. is primarily tech and service based, and a lot of it's because of the Mag 7. The issue is I think their ability to grow with the law of large numbers becomes increasingly more challenging ahead. So I think the growth side of the coin slows. Okay. In 2026, I'm looking to rotate pretty hard into some other spaces. I think that, look, I trade the indexes a lot. So I am in SPX a lot. I trade SPYs and Qs a lot. In fact, I've got a trade that I'm going to dial up today for Pulver alerts, because we're in such a, it's a crazy elevated VIX. I'm not going to say it's a high VIX, but 20 is high. And there's a lot of uncertainty brewing. Nick showed the edge finder with the AAI sentiment. I mean, having a bearish print again at 49%, there is a complete disconnect between what people think and feel versus what the market is doing. And I'm a big believer in that, like, natural contrarian aspect of the markets, which are, if everyone thinks that a bubble is here and everyone thinks that a recession is here, the market's not going to deliver on that right now. And I think if you follow the money and follow liquidity, you're going to see that things are still going to be relatively stable. 2026 to me is probably going to be a trader's year. 2025 was, I said the same thing in 2025. It's going to be a trader's year because we came off of 220+% years in 2023 and 2024. So I thought, yeah, okay, it's going to be hard to repeat that again. And, maybe we do. Maybe we're sitting here at, 14, 15% for the year. Maybe we end the year on a positive note. We stabilize and we kind of, maybe drift up to that 7,000 handle, which we're trading at, 67 right now. Could we drop to 65? Sure. Could we, test some levels? And I'll talk about some of the technicals when I get to the slides. But bottom line is, follow liquidity. Unless there is a intentional tightening of credit and intentional tightening of money supply, the markets will still be looking for, the wheels are getting greased, liquidity is flowing, and naturally assets drift higher. It might not feel great, and we have no idea what 2026 is going to do. But the $4 to $5 trillion through a big beautiful bill, a lot of liquidity hits in 2026, and additionally, it's a midterm year for the U.S., which I'm pretty sure that right now that Trump and company sees the risk of the uncertainty that's been caused in 2025 politically has also created probably some of their base is maybe on the fence. I'm not going to say that people have swayed of like they're going one way or the other. But what's happening politically voting wise is when you have a Mondani type vote in New York, where you have like far left policies versus right policies. You're talking one of the biggest like free market capitalistic cities in the world. New York City is now going under a very, left friendly / people are arguing like socialist agenda. So that's crazy. And again, are there going to be more of those signs in 2026? Well, that's the big threat for the midterms. And I think that's where a lot of the risk will be through 2026, is we have a good kind of first half of the year where liquidity's flowing. The Fed, whether they pause in December or not, they're probably going to cut, because if you remember, Jerome Powell's term as Fed chair is done in either March or May of 2026. He might still be on as a governor or some type of Fed member, but he is no longer going to be the press conference guy when we talk about FOMC. It's going to be somebody else. And that somebody else may not be crazy dovish, but I do think it's going to be more of like an extension of the White House versus, this independent entity like the Fed that has essentially just been conflicting with Trump and company the entire year. Okay, so let's talk about this. Let me go through some slides. Let me get my notes here. Here we go. All right. So highlights of 2025 so far, frothy valuations. The one thing that does have me nervous is I have a couple slides here, like forward returns when we have valuations in the, 23, 24 times earnings. You look at the Mag 7 at, nearly 30 to 31 times earnings. Some of the companies like, I know Tesla still price to earnings is like 200 times or 150 times. Palantir got up to like ridiculous level, stuff like that. The frothiness, I'm cutting some of that nonsense out. I mean, I think Palantir's been a great ride for a couple of years. I probably wouldn't even touch Palantir in 2026. Tesla I'll trade because I think there's a legitimate AI play if we're looking at, humanoids, profit margins, dark factories. If the US can ever create one, I feel like Tesla is one of those companies. Same thing with Amazon. AI hype. What I don't want to see is this. If a company doesn't make any money, it's probably not going to be in my portfolio. I think it'd be silly to speculate on like, quantum computing that has already ripped like 100 to 200%, or an AI hype trade that's already ripped up 100+%, and then try to chase that thing at the highs. No, thank you. If I like the stock, let's do some digging. Does it make any money? Is it in the web of NVIDIA and Oracle and CoreWeave and Meta and Microsoft, or whoever's in this like, inner circle of like, we buy the chips from you, you'd sell the chips to this person. It's, like there's like 10 companies that are doing all this stuff. Those companies are now interrelated and intercorrelated, where they need to keep each other either accountable or also profitable. If somebody slips out, I think CoreWeave like kind of rattled this a couple weeks ago, when the demand is so high, but they're also saying like the amount of spending that it takes in order to get that return. I mean, OpenAI could be a huge concern, because they're talking about, they might make like $1 billion in sales, but they're asking about $1 trillion in spending or raising. They want to raise capital for like $1 trillion in order to get this spend. Like mathematically, it doesn't make any sense. Nobody should be spending $1 trillion to make a couple $1 billion in profits. So be aware that fundamentally that's a terrible trade. Okay. All right. So that's my first point is we got some frothiness out there. I am not a big tech player going into 2026. I think the better plays, and I'll get to where I'm rotating a lot of my capital. It's heavy index trading, lower volatility, and it's boring stuff. I want to benefit from the physical side of AI, not the tech and hype side of AI, right? So we'll talk about that in a little bit. Trump administration, paradigm A, B, C, and D. I'll talk about this specifically. We are in a paradigm C right now, which is essentially, yes, it's a K-shaped recovery, but the idea with paradigm C is you take the K, I'm not trying to do the K, you take the K and you're supposed to flip the bottom. So now they're both going parallel. So it'd be something like this. If we have a K-shaped economy, this all started during COVID. So your K-shaped is this way, right? That's your K-shape. What paradigm C is trying to do is you can't necessarily crush the top of this, but you can maybe help and assist the bottom. So we go from a K to an E. There's still a huge wealth inequality gap, right? We know that. And it's just gotten worse, and it's been exacerbated by, the dot-com bubble to the great financial crisis to COVID to now. It just gets wider. And the bottom half of the socioeconomic ladder is doing poorly compared to those that have assets. I get it. But paradigm C is also keep the party going. Okay. Because paradigm C is all about growth. And if we can properly grow, then paradigm C stays intact. If we stall and we cannot grow, then there's still a kitchen sink Hail Mary, which is paradigm D, which is we will print our way to kind of make sure things can stay afloat. But if it fails, paradigm D is the scary stuff that's like fourth turning. And there is there's complete like chaos and turmoil when it comes to policy, and then everything has to change, and there's going to be like massive casualties, and it's not going to be easy, but innovation comes from it. I mean, I would say paradigm D was, I'm trying to think when our last like fourth turning paradigm D would have been. I honestly, I don't know, but any type of major crisis we've had, the internet came out of a crisis, and the internet is, look at how convenient it is for us to be trading, do what we do today. If it wasn't, one thing I always think about is if one EMP hit a major city, I feel like people would be, there's funny commercials that make jokes of it, but it's like within, days, it's like people would be killing each other, because all of a sudden it's like we're going into, fight for yourself. It's Walking Dead type times, and it's like, okay, we'll fix the power outage, everybody. But in 2 days, it's like we're gonna rape and pillage. We'll be looting Costco's and stealing all the water and batteries, and all of a sudden it's like, yeah, we just fixed the power grid. So anyway, I don't want to see what a paradigm D looks like, but eventually, if we can't grow our way through things and keep things afloat, then some nasty stuff can happen. But again, the markets have been around for over a century. What is kind of crazy is think about this: in 2029, that's going to be the 100-year anniversary of the Great Depression. Something is putting that to me as a red flag. Like, this market might have something surprising in store for us, like at that 100th year milestone. Like 100 years later, the market did exactly what it did in 1929, which has had this nasty crash. But that is, several years away. So we'll figure it out. Anyway, what's going on right now? Inflation versus labor. This has influenced Fed policy. They pivoted almost a couple of times the last few years. The Fed has been very wishy-washy. Everyone's saying that the Fed is behind the 8 ball. They're always behind the 8 ball. No Fed ever has been proactive, ever. even Jerome Powell, even Janet Yellen, they're all reactive. So right now we are cutting rates because of a slowing labor market, not because of a, improving inflation market. Inflation is still sticky. Global PMIs are rising. Inflation is likely going to slowly, whether the data is being suppressed or not, it is going to slowly rise. If you look at third-party measurements like trueflation.com, inflation has been going up since August. Maybe it's 1/10 at a time, but it's still going higher. And we're so far away from a 2% inflation target that I think is realistic, that I think the Fed is truly acknowledging that we can probably have a 2 to 4% inflation rate and still grow. We do need some inflation to grow. And I think inflation at 3 or 3.1 is, manageable. Inflation rising to 3.5 is still manageable. It's not going to be fun. People are going to see it. But the labor market right now is probably the biggest question, over the next maybe 12 months. So softening monetary policy to kind of assist in the labor market, trying to see if anything happens in the long end of the curve. If we truly get the lagging data to come in and have deflationary pressures, these could be improvements. Like maybe inflation does improve a little bit, stabilize, maybe come down. Hopefully that's the case. We'll see what Fed policy gets us. I think that the big shift last week, the reason the market was a little bit, selling off in the last couple of weeks is, number one, we needed it. We nearly touched 7,000 just a few weeks ago on the S&P. But with the Fed all of a sudden going like 50-50 now, the Fed Watch tool for December is showing like a 46% chance that they will pause. I'm sorry, it's like a 54% chance they will pause and like a 46% chance will cut. So the probability is flipped that there's not going to be a cut in December. Again, that's not a deal breaker because going into 2026, I mean, within a January to May window, there's like one more key Fed meeting, like between January and March. I think that's the next two Fed meetings. I mean, if they're making a decision to cut, inflation data comes in, better over the holidays, then they'll probably resume cutting. It just might be like a rocky / sideways December. We will see. Okay. History rhymes rarely repeats. I mean, we know this. It's like everyone's talking AI bubble. It's just like the 1990s. Is it though? It's not. I mean, people that look at the data, I've got 3 really good charts that show why it's not the 90s. But I'm cautious. I think that if you take the emotional side, you take the fear and greed and you throw it in the markets, that's why the markets don't go in a straight line, right? We're not going bottom left to top right. We're not going, top left, bottom right. We're going ups and downs. Like the market has up, down, sideways cycles. We're still in maybe the late innings of a bull market, but as it's like the average bull market can last 4 to 5 years. 2022, at the end of 2022, we've officially crossed like 3 years into a bull market. I'm, a little skeptical of like how aggressively bullish the market can stay. But even in the maturity of like a late innings rally of like, let's say we're in the 7th, 8th, 9th inning of a bull market. Okay. But nobody can put a price tag on that. Nobody can say that, yeah, the market's going to stall at 7,000 and go down 20%. I mean, maybe the market goes to 7,500, right? What if we have another, 10% higher, 20% higher? Everyone talks about bubble. If you want to see a bubble, you're going to look at like, I'll pull this chart up and I'll share it this week in my the A1 Trading Discord. If I find the chart and I want to build it out the way I want to, I'll show you what a bubble looks like. Like technically speaking, it is so ridiculous from like Bollinger Bands, Keltner channels, regression channels. Like bubbles are pretty easy to see technically, and we're not there yet. We're not there yet. Like prices aren't ridiculous. All right. End of year animal spirits and cautious 2026. Yes, I am cautious into, I'd say August to December 2026 is probably my biggest caution because we will see what the midterms shape up to be. I think if there's major shift in policy, then that could be very disruptive to the current administration. And I think that policy is, the pendulums are severe enough in policy for the U.S. right now that if we see everything that's been put in place in 2025 is going to be appealed or threatened or questioned, or, it's just, we just have like a fighting political system and it's a freaking circus. But I would say into the first half of the year, if we can finish the year with decent animal spirits and we're stable and, okay, US and China are playing nice, whether the Fed cuts or not, or they pause or not, I don't think it really matters. We have to watch price action. Here's my key level. Watch the October 10th candle. October 10th was that crazy one-day sell-off that we had. That, to me, is a critical spot where if the bulls can maintain price action above that and the bears are not able to close below that, we stabilize. And if we drift up to the end of the year, so be it. Once we get through next week, Thanksgiving, it's like the markets tend to just be in limbo. And if there's like a positive float to that, buybacks are still in, earnings are pretty strong, consensus is pretty decent, there's money flow coming in. I think we have to pay attention to that and see if we can finish here on a positive note, right? I mean, some people have, I've been reading the argument that, portfolio managers want to take profit at the end of the year and they want to get paid. Right. But if they take profit and the market goes down, it's like, I get it. But also if we stabilize in the end of the year and you can generate some premium and income, you can put in a collar trade, for crying out loud, right? You can have like instant protection to the downside without having to pay for that. So I think if anything, October 10th candle is my big technical level. If we stay above that, things are good. Right. We break below that. Okay. We'll have a unfortunate little washout at the end of the year, and we'll figure out where, liquidity comes into 2026 if things look a little bit better early in the year. I think the first half I'm still pretty bullish. Top plays and strategies. Let's get to that. Okay. All right. So future growth is concerning. I've used this chart before. Actually, when we did like the halfway point of 2025, and Nick and I had some sessions, this little scatter plot is showing us that at current PEs, right now I think the S&P is like a 22 price to earnings, 23 times earnings. Forward thinking is not great. Like you go out 5 or 10 years, the average returns are pretty disappointing. Like you're talking, single digits on the upside and potentially, 10 to 20% pullbacks on the downside. So that risk adjusted return is something we need to be very aware of. I am cautiously bullish in 2026. I think that the markets will rotate pretty aggressively. I think that, chasing growth stocks, chasing tech could be challenging in 2026. I think, when we come into like the late cycles and what kind of leads us into maybe a rotation on a Mag 7 would be things like energy that's non-correlated, or utilities that are boring. And there's like, blue chip stocks and dividend stocks and things that are like fairly safe and low beta. That's not a trader's paradise. But if it's stable and it has some appreciation to go with it, and you have a dividend on top of that, and you can sell some premium, I think I don't need a stock that's going to have to go up 100% to make money. It's like, just give me a 5% dividend. Let me make some income on this, and I'll trade this thing, 5 or 10 times for the year. Give me a basket. Give me an ETF. Give me some upside momentum in something that's been a beat up sector for a while, right? Healthcare, financial, utilities, industrials, like all these things could be good places to be. Energy as well as non-correlated. Okay. But forward returns are not great when we have these current valuations. If you're watching the Cape Shiller's up into the 40s. I think the highest we've had is in the like 43, 44. That was right before the .com crash. So it's a concern. Doesn't mean that we're the highest valuations ever in history, right? So the markets can remain. Market noise. We talked about this before. Trump is a very vocal president. Whether the market likes it or not, sometimes he catches the market off guard. Sometimes the market, puts on the earmuffs and silences the noise. Other times it listens. Trump on China has been very noisy. Trump on tariffs has been very noisy. The market was obviously very worried about this early in the year, started to ignore it through like May's and June's rally, and all of a sudden it started to chirp back up again, in the last couple months. I still think Trump and company, administration, US-China play nice. Right now it's like, I think it's more about like the labor market and the sense of where is the economy going? Are we getting too far ahead and ahead of our skis, or out on our skis with AI? Is this a build out that's just we're spending too much and there's no return on investment for that? That's where I think the rotation comes in. Okay. So all this stuff is showing this is the S&P on the top and the VIX on the bottom. So when it's been vocal by Trump, we essentially cause tops and bottoms in the market. So a lot of market noise. Here's the paradigm stuff that I was talking about, ABCD. Okay. COVID was the K-shaped recovery. You give money to the citizens, they YOLO it into nothing, right? I mean, I received a check for like $1,100 during COVID. I got one of the 3 that were passed out. Did I take that $1,000 and put it into Bitcoin? No, I already had money in Bitcoin. But it's like for people to say like everyone did this and everyone made so much money, it's like, did they? I mean, I just think if you're talking about Trump tariffs or tariff dividends for $2,000, I mean, it's going to be a tailwind for the stock market, because if it goes in there, it's going to be probably 10 to 50% of it finds its way into the stock market. In fact, I look back into 2020, 2021 when these checks were mailed out, the post-COVID stuff. And I think it was like $800 billion were given to U.S. taxpayers, and about $100 billion found its way into the markets. So again, I talk about follow the money and follow liquidity. $2,000 isn't going to change anybody's life, but $2,000 into a gold investment or the S&P or Bitcoin might change, for the better in the next maybe 2 to 3 years, 2 to 5 years. Who knows? Okay. So anyway, K-shaped recovery, because The haves, if you had assets, everything has changed. Houses are more expensive. Literally, life is more expensive. There's nothing in my life and probably nothing in your life that has gotten cheaper over the last 5 years, unfortunately. Okay. Our dollar doesn't go as far. We get it. Like that's what everyone feels. I think that's why the sentiment is so bad, is like haves versus have-nots. Trump and austerity, big pivot in 2025. This is where we basically saw like the March, April correction. We were talking austerity, we're talking Doge, we're draining the swamp, all these threats. What happens? Well, as soon as that was happening, the bond market flinched. We saw the basis trade blow up. We saw the rate of change go like exponentially higher than it normally should on a standardized basis. And the bond market flinched, and all of a sudden Trump flinched. And all of a sudden we went from austerity and Doge to let's spend, let's grow. We got to grow. And that's the pivot that's been taking us all the way into this. I say this again, I do not think the US can really afford to have a recession. And if the US can't afford to have a recession, the world can't afford it either. Which is why I think everybody's in the same boat. There is debt like pouring out of everybody's ears in the world. Like our global debt is laughable. It'll never go away. Okay. Debt is never paid. It is refinanced. And so I get that the US has like $6 or $7 trillion, rolling over. I get that the global markets have like 30 to 40 trillion dollars rolling over. It's going to find a home somewhere. Credit spreads are not blowing up. Okay. Like credit still remains pretty darn tight. Yes, we've had some cockroaches, as they say, but that's in private equity. Until everyone wants to be liquidated in private equity doesn't have to go mark to market. And therefore it can kind of stay in its like insulated like closet where everything is safe and nothing has to come out and show like, oh, you're just taking a 2 and 20, leveraging the crap out of this and, eliminating all volatility to make it look good on paper. Well, that is private equity. It's been like that for a long time. I get concerned if private equity truly goes public. I don't think anyone really wants it to go public, because if you take private equity public and you have to show the real volatility underneath the surface, you have to show true financials. I think it's going to show how terrible some of these deals actually are. And interesting factoid, a lot of wealthy people that are in private equity don't make money. It's just like, it's almost like a money market fund or mutual fund for a very wealthy investor. If you're a limited partner in some private equity funds and you're being told like, oh, things are good, low volatility, blah, blah, blah. It's like the only way you make money in private equity is by somebody selling it to somebody else. Mark it up, make it look good. Somebody else buys it. There's your return as an LP and you go to the next project. But if they just sit and hold, most private equity investors don't make money. Is it concerned that, Yale and Harvard and some of these massive like $5 to $10 billion endowment schools that are tax-free are trying to dump their private equity? Yeah, I think that's a concern. But if it stays private, that's a good thing. I'm more concerned when you open up 401ks to private equity investments. When you open up like, hey, the public, it has the privilege of buying this stuff. I think we're going to be buying people's crap. I think we're buying, the CDOs of private equity type stuff. Like we had back in 2008, the collateralized debt obligations that pretty much were the topping point. If you ever watched The Big Short, you take all the trash and you put it into this nice little wrapper and say like, this is private equity. Congratulations. You now have access to this stuff. The garbage that's in there, I think will end up coming to the surface at some point. So anyway, I don't know where I was going with that. Other than that makes me concerned for, if the retail crowd is getting given the bag of garbage to be like, this is what allows Wall Street to give away their garbage to us as retail traders. All right. Anyway, point C, grow, baby, grow. That's where we're at right now. This is where we are right now. Okay. We are here. We are trying to grow. We want to grow. We think that the only thing we can do is grow. PMIs are rising. Yields are sticky. The long end of the curve isn't coming down. Assets rise. Okay. If you are an investor, assets rising is a good thing. Whether it's up aggressively or it's steady, but assets going up, whether it's a consistent debasement, whether it is, having gold and silver in the portfolio, having gold, silver, Bitcoin, whether it's an anti-fiat play, whether it's owning real estate, land, whether it's owning stock market stuff, owning stocks, assets rise. So I don't know how much longer this goes, but right now this is pretty much like this is where we're at. Like this is what the administration is focused on. I think if we don't have a major political disruption in 2026, we will stay on paradigm C, which is still continuing to grow. We might actually surprise ourselves with how much we can grow, maybe. Okay. But what I showed and talked about earlier is if we stall and the growth shows like, hey, all these Mag 7 companies have spent $1 trillion in this AI build out, where does that go for investors? If the answer is nowhere, if all of a sudden, like, spending 35% of your sales on a CapEx build out or an AI build out is going to return jack squat for investors. Yeah, I mean, you're going to see another nasty rotation. And I think this is where I'm starting to see some of the aggressive rotation happening now. I think this gets more and more aggressive and more obvious in 2026. Okay. But that also means that there is a broader market out there that doesn't just live and die by the ups and downs of NVIDIA and Mag 7. NVIDIA has earnings this week. I wouldn't be surprised if NVIDIA delivers on earnings. Okay. But what I don't love to hear is that if companies are adding debt to fuel an AI boom or an AI build out, that doesn't make me happy at all. I think that's the biggest threat. That's probably the thing that rivals what 1999 was, which was this, crazy melt up where the indexes were up like 80 to 100% before they crashed. That's a bubble. We haven't seen that. We're up, 14% this year. Okay. We're up 50 to 60% the last 3 years. Okay. That's still okay. But if all of a sudden we have upside risk where the market bubbles to an extra 20 to 30 to 50% to the upside, now we're talking bubble, right? Like you can see on a chart what a bubble looks like, and it's not right now. So if we pivot where all of a sudden we realize, oh my gosh, we cannot grow. We are throwing everything at this economy. It is stalling where our plane has been on trajectory, and all of a sudden we've leveled off, and now it's starting to stall and start to go down. We don't know how far that thing falls to hit some trees. So when growth stalls and fails, everything you can throw at it, right? Every tweet that Trump says the market goes down, every Fed coming in and saying we're going to cut rates and market's going down. If price action is going to dictate how nasty this thing is, I mean, I'll make it really simple. I've got a couple of indicators you can just watch. Indicators: if price is above it, stay bullish. If price is below it, be cautious and possibly, have some cash or have some stuff ready to, dollar cost averaging on some discounts. Okay. All right. Fed policy, we talked about this big pivot this year and now focusing on primarily it's focusing on the job market, not inflation. Have we tamed the inflation monster? No, we haven't. But I do think that because of energy prices, things have been relatively quiet on the inflation front. I mean, we've had a low of 2.3 to a high of 3%. We've gone up, 7 ticks, 7 tenths. Not a big deal. It's higher, right? It's not 2%. It's not sub 2%. But there's also a lot of lagging data built into our inflation numbers. I like to use Trueflation. I think that takes third-party measurements of a lot of things, not just cut out grocery store prices, cut out energy, cut out everything we pay for that we see every single day. Like, give us a real reading. So, like I said, since August, we have seen upticks in inflation. We've seen some rallies in BMIs as well. But the labor market concerns, we've had major revisions where basically the entire Biden administration, we had 1 million plus jobs revised lower. We haven't had non-farm data in over a month. We had the longest shutdown in government history. So, I mean, even when the data does come out, it's probably going to be an easy spin. Like, don't believe that. That's not real, right? So data is tough right now, but the Fed is accommodating the softening labor market. Okay. If they decide to pause for whatever reason in December, okay, fine. But don't be surprised if the market picks right back up in January to March and the Fed is easing once again. So, keep an eye on those levels getting contained. Like I said, that break point to me would be that October 10th candle low. Okay. I'm also watching bond yields in the background. Watch the 10-year yield. It hasn't had an aggressive rate of change. We are not lower. The 10-year yield has not gone lower. Okay. So we'll talk through that. All right. What else? This is the 6th bull market to reach 3 years since 1974. Okay. The average bull market's 4 to 5 years. We're still not necessarily in the extended timeline of a, end of a bull market. We could still have a bull market for the next year or two. So I'm just saying, don't count out the bulls when the money is flowing. When you've got liquidity and you've got global money supply, don't count out the bulls. It's like it's a self-feeding mechanism where it's like if there's money going in, there's forced buyers, there's stability, there's inflows, assets rally, assets rise. Don't fight it. So it might be cautiously bullish, but do not fight it. Okay. All right, let's go forward. End of year rally or stall. Well, we've clearly stalled a little bit. We hit 69.20. That was our high for the year. We're trading at 6,700 right now. 6,711 is my live price right now. CapEx spending is coming in hot and heavy. NVIDIA has earnings this week. I think that's going to be what sets the tone for possibly the end of the year. So if NVIDIA earnings, keep an eye on it. It could be very noisy. A lot of the stuff is kind of baked in with the options market where NVIDIA is going to go. There's a ton of leverage on NVIDIA right now as well. So you take like the asset NVIDIA, you take the hype around it, you take the leverage around it. NVIDIA all by itself could move the market, 0.5 to 1% easily. But I would expect them to hopefully have a solid earnings report. I think if they do and they stabilize things, it kind of soothes the concerns of this AI hype and builds it into more like, okay, this is real. This is real money getting spent. This is real things getting built out. I'm just going to take a different tactic on how I trade it. Okay, labor market. I think if the labor market stabilizes, this would be a good thing. What I'd like to see would be, we had one print of ADP numbers. I'd like to see one print in non-farm payroll and not have it be negative 20,000. If we have a non-farm payroll data point that's showing, 30 to 50K or even 75 to 100K, if there's, I don't care if you have to fudge freaking holiday trading or holiday labor, give the labor market something to be hopeful on. And I think it stabilizes for an end of year rally. Okay. November, December typically are pretty historically bullish. There's usually a bit of a stall into some of what the mutual funds do in December. The blackout period, we just had it. So like buybacks are now like open season again to kick off the end of the year. November, December, January, typically very bullish for the stock market. A bit of concern in like the weakness window, February to April. Let's see. U.S. and China. I mean, I had this slide, almost a month ago, but this is the back and forth of will U.S. and China get along? What about tariffs? What all the back and forth? I just put U.S. and China as plain nice, right? Like it's not even the news right now. Like Trump basically said it for the day, tacoed the next day. Like we had a nasty Friday. Monday we were up 1.4%. We tested lows. We went to all-time highs after that. Like it's noise, but I think the U.S. and China will continue to play nice. It might seem like optically contentious, but I think they're going to play nice. Okay, here are some technicals. You want to put this on a chart. This is some of my go-to stuff when it comes to whether or not I choose to be bullish or bearish. Usually I'm bullish. Okay. The 144 moving average. This is what you can use a simple. I use an exponential. So a 144 exponential moving average to me on a daily time frame, if we are bullish and prices holding above the 144, and there's plenty of room, by the way. There's a lot of ebbs and flows that can happen within a 144 moving average. But if we stay above that and primarily above the 50 period moving average, pretty bullish. Okay. The 50 period moving average the last couple of weeks has been tested. I've been talking about that for a while now. It finally got hit and we tested it again last week. Okay. I don't want to see price going below it without kind of closing back above it pretty quickly. So if the 50 period can stay above the 144, I will remain bullish in the markets. If the 50 period crosses over the 144, I'm cautious, probably indecisive. And then I want to see what's next. Does the 144 offer support? Does the 200 moving average offer support? If those levels break, you've probably heard of the death cross. The death cross is your 50 period moving average with your 200. Okay. So with the 50 and the 200 cross and prices below that, be very cautious because that usually is the death cross where if we don't immediately rally from there, that's where the market slides and, has a pretty nasty correction. You're not going to call the top this way. These are obviously moving averages. These are lagging indicators, but you will stay out of the messiness if you're just looking to go into cash or be in the indecision zone or waiting to kind of buy discounts and dips. Okay. All right. AI plays. Physical side. This is my top strategy themes. This is my rotation for 2026. I like utilities. I like the physical hardware side. I don't really want to trade semiconductors necessarily, but I will trade the energy side, utility side, the material side to build them out. So XLE, XLU, individual stocks within the energy sector. I'm long Chevron. I'm long ExxonMobil. I think oil is probably a bearish trade into maybe the next year. If we're going to see deflationary pressures as well, if inflation goes lower, I think oil prices head lower. I'm bullish natural gas, but I'm kind of bearish oil right now. I think oil can slide into and it's not immediate, but I'd say over the next maybe 1 or 2 years of oil slides to $40 or $35 or $30. I am then going to get very bullish on oil and get very long on oil for a 2 to 5 year play. I think there's a lot of upside there. Natural gas, I'm long. We're trading at $14 natural gas. UNG is my reference point. If UNG gets back to $20, I'll probably take profit. I'm not forever bullish on it because I've called it the widowmaker for a while. Natural gas is a very difficult thing to trade. It has these wild cycles, and if I can go from 14 to 20, I'll probably take profit. Utilities, super boring. Crazy good cash flow for utilities. It's like a dividend stock with low beta. It doesn't move a lot. It's not very volatile. But if you have a 4 to 6% dividend on a price that probably goes up, right? I think what puts stress on the energy grid might be a little challenging for utilities, but it almost feeds into holy crap, these things are needed. These companies are needed. They're making, I don't know, probably profits hand over fist. So I think for a lower beta, lower volatility play, like I'm not interested in chasing the hypiest of hype names. I'm interested in what's the physical side of AI that we have to have. Energy valuations are still super low. Utility valuations are still super low. The value side of the market has been, underperforming for years. It's not exciting. It might continue to underperform, but I don't mind getting some stability and some performance out of something boring and way less volatile. Like in 2026, if I'm cautious, I want to eliminate as much volatility out of the portfolio as possible. Make sense? Okay. Gold, silver, Bitcoin. I think these are must-haves. Oops. Sorry. I think gold, silver, Bitcoins are must-haves when it comes to a percentage allocation. I've seen some percentages as high as like 30% gold. I personally have more of like a 10-10-10 going on. So I'm about like 60 to 7% of my allocation in stocks, indexes, lots of options. And then I do a split of like 10-10-10. I've been long gold and silver for the last couple of years. I've been long Bitcoin since 2017, much heavier into the 2020, 2021 cycle as far as like, adding it to like client portfolios. But gold, silver, Bitcoin, to me, I'm happy with 10-10-10. I wouldn't mind higher. I wouldn't mind going like 15-15-15 or making an even split where this is 50% of my portfolio. That's a little bit higher risk than most people. And there's still an unknown, right? I mean, gold having a great 2 to 3 year run does not mean that gold is going to have a great, next 6 to 12 months. In fact, one thing that's probably going to be interesting to watch is how gold and silver and volatility can shake out the loose hands. Retail didn't get super excited about gold until it was already at 4,000. Retail didn't get crazy about silver until it was already at all-time highs. So, I mean, I wouldn't be surprised, and I've been talking about this a lot technically. The 200-day moving average on gold is still not touched. I think gold will have a very difficult time going higher until that level's hit. So I'm going to dollar cost average into gold and silver. I'll build up my percentages I want. I think 10-10-10 is fair, and I can do a lot of trading with the indexes and options. Cautiously bullish, buying the dip, watch your structure. If we're above the 50-day moving average, we're above the 144, buy the dip until price proves otherwise. If there's no real bearish confirmation, then I'm not a bear. Okay. Downside protection. I do this a lot. I have some risk trades. I'm long the VIX every now and then. I'm hedged on the SPY. I'm hedged on the Qs. I'm hedged on futures. I use the futures market quite a bit. In fact, if you look at my portfolio, I have ES, MES. Most of those future positions are in red because I took a 40-1 reward to risk trade. If I'm right, I get I risk $900 to make like $40,000. If I need it, it's there. But if I don't need it, I throw it away. I risk like 1/4% of my account for a 3 to 6 month window, and the price doesn't go down. So I think downside protection is you're happy to have that type of insurance if you need it, but it's not going to be fun. I can promise you, like, if I got paid $40,000 on a hedge that I only paid $900 for, somebody'd say like, oh, that's an amazing trade. Right. That's an amazing trade, but that's only serving the purpose of helping me offset all the crap that is happening with my original positions. If I'm invested and I'm long and I've got a tilt to my portfolio, which I do, it's helping me protect that. So as the market might drop 10, 15, 20%, I'm down maybe, 0%, maybe less than 5%. Maybe I'm actually coming out ahead of that because I've been raising some cash through the last couple months. I've been a bit more cautious. So protection for me is, I don't like to throw away the trades, but it's the insurance that I can sleep well at night, knowing like if something nasty were to happen, I'm going to be okay. Okay. But for the most part, keep the party going, keep the wheels greased, keep following liquidity. And if the markets maintain the posturing that we're talking about, keep a close eye on that stuff. Okay. All right. This is just some of the core strategies like Pulver alerts, for example. This goes back 13 years. Thought I'd just share something pretty interesting. This is one simple mechanical trade that you can put into the indexes every single week, and it pays pretty well over time. Here's another one. Every single week. Okay, so stuff like that I can do for Pulver alerts. I'll get into the charts here in a moment. I've got a few more minutes, which is good. I'm glad I made it through the slides. So I think we're also doing, we'll honor the 45%. I know Nick did that earlier. So I think we're at 45% on your Edge Finder, and you can throw the Pulver alerts in as well. Use code Pulver. Okay. So my point is there's a lot of ways to trade in 2026. You're not going to see my Pulver alerts chasing any hype and chasing AI, chasing stocks that are already up to 200% gains. You're going to see some safe, high probability, boring stuff that helps me generate. If I can do a pretty safe, low volatility, 10, 15, 20% a year, I'm very happy with that. I crossed up almost 40% for the year in 2025. I've given some back. I think Bitcoin's been a little bit of a lag for me these last 3-4 weeks. And all this is an open position. I'm just scaling back into it, but it's pulled my nets down to like, low 30s right now, which is okay. But like I said, if the animal spirits get lifted and we kind of stabilize for the end of the year, great. Or maybe we have a good push into Q1, that's fine. I'll kind of carry that over into 2026. I am, for the most part, stable to bullish outlook in 2026 through at least the first half of the year. I get a little bit more concerned if it looks like midterms might shift and go to the Democratic side. If that's a big policy change, I think that makes things disruptive for the next couple of years through a lame duck presidency where Trump doesn't really have the same power because he doesn't have the majority, right? But for the first half, it's like big, beautiful bill, liquidity, Fed's going to cut, new Fed chair. As long as U.S.-China plays nice, we don't hear a lot of crap on disruptive tariffs. Keep the party going. I think that's where the market's at. Okay. So 45% off Pulver alerts. I'd love to see you in there. Also, there's a bonus in here. If you add Edge Finder, get the Pulver alerts. There is a $500 bonus course that I throw in called Practical Options. I built that originally for my nephews who were at the time, they were like 15 and 18. And now they're 17 and 21. Or 18. They're about to be 18 and 21. Anyway, I built that for them. And they're kids and they don't know how to trade, but now they do. I also gave that to some of my clients that were 80 years old. So if you're somewhere in the middle, whether you're a teenager or an 80-plus-year-old, my goal is how quickly could I show somebody this is my favorite way to trade the markets. Options has changed the way that I manage money. Options has changed the way that I manage risk. Options has made me a much more profitable trader and allowed me to lose gracefully and lose with, what the loss is ahead of time. There's nothing more frustrating than being in the futures market or being in the currency markets when you set your stop losses and you get pinged on those stop losses, the price goes your way. Or you see the prices keep testing and testing those highs and lows, and it's those liquidity feeds that everyone gets beat up on, and then prices go your way, right? I mean, so I tend to deleverage in futures and deleverage in currencies, and I tend to scale in and build my positions up because I know the markets like to test those liquidity levels. But if you think about this, I'll leave you with like a really nice bias. 80% of the time, we've had a century-long stock market, okay? 80% of the time, the market's been bullish. That's a pretty good house edge, okay? If you look at the market since 1974, the options market was created in 1973. Since the options market inception, 1973 to now, let's call that the modern market, right? 1973 to now. 55% of your weeks, 55% of your days are bullish. That's a nice edge. So American casinos have a house edge of about 56%, which means if you play long enough at a casino in the US, you're going to lose everything. That's why they're designed that way. In the stock market, if you have a 55% house edge, you know what side to trade. It is more beneficial to be long these markets and just make sure you manage risk to the downside. If that is the only advice I can give you, is like, just care about your risk enough to know that you're not going to blow up an account. Survive and trade today, survive and trade this month, survive and trade the next 3 to 6 to 12 months, be in the Pulver alerts for the next 3 to 5 years, 10 years. You'd be amazed how far we can get by making good trades, good probabilities, and a base hit goes a long way. I'm not a home run trader. I never have been. My home runs were when I had lightning in a bottle back in like 2013 and 14, and I was trading too big. Frankly, I was trading too big and I was over leveraged, but it didn't matter because I was spot on with all these trades. Fast forward 12 months after my lightning in a bottle, I was also in a 25% drawdown on my entire portfolio. That was a little eye-opening lesson. So once I experienced stuff like that, it's over a decade ago. You learn, you evolve. Point is, if you care about risk, manage risk, the upside's actually pretty easy. Making money in these markets can be easy. It's if you're just leveraged to the max and leveraged to the teeth and you're going for home runs. Those home run trades, they bite both ways, right? I mean, leverage is a double-edged sword. You know this. So it's like it can make you money as well as crush you. So I'm hoping nobody's watching this thinking, hey, I'm in a five leverage ETF, Chris. I love this stuff. That's not my style. I'm a trader that's going to get on base thousands and thousands of times. And I do very well with that. And that's also why I've been doing it for 25 plus years. So it's like, to me, real trading isn't glamorous. Real trading isn't like, I'm going to pick out my Lamborghini and I'm going to take one trade and I'm going all in on. It's not like that. Trading is I know whether the market goes, flat for the year, up 10%, down 50%, I'm going to figure out a way to make money. Right? I mean, if we have upside risk, great. Upside is pretty easy. Everyone has a blast in a bull market, but you separate yourself as a better trader when you can survive the downturns and you're not going to get busted up. Okay. All right. Let me do this. I'll minimize this. I'm going to go to some charts. I've got a couple of alerts. We're still VIX is at 21.6. I'm going to take a trade right here. I did this already, but I just had a fresh account land for me. So I got a new client that came in this week and their money cleared this weekend. I'm going to take a fresh trade for the Pulver. I've got a couple trades in. They're all income-based trades for December and January. I've done that in the Pulver alerts. I'm going to take a trade right here. Let me go into, let's see if I can go SPY for end of the year. I'm just going to sell. Is it good right now? Not really. SPY December, Q's December. Let me see something. I actually got a pretty good trade in this last week. So that's not what I wanted. Let me go out a little bit farther. I'm going to go June 18th or June 30th. I'm going to go quarterly. Let's look at the SPY. This should be a pretty good trade. So if I go 500, 480. Okay, here's an income trade. Now, a couple ways to trade this. I can either do the ratio spread here at the 480, or I can spread this out. 500 by 480. Let me see what I can get for income. This isn't terrible. It's going to take some capital here, but I'm going to build in a nice little profit trap. I can make $324 on the trade. If I just did the 500, 480, that's a $2,000 profit trap. I would take some ownership. That'd be about a 33% discount off of current all-time highs, which is a pretty good place to start. Probability of profit's like 99.5%. So I don't mind this trade here. Let me see. That's 385. Hang on. I'll figure out how I'm going to craft this. So buy the 510, 480. Let me go 2 here. So that's a $3,000 profit trap plus the 350 credit. Not a bad trade. Okay, if I wanted to tighten this up, this makes me over $4 income. I don't mind the profit trap. This also, watch my delta here. Delta's 4 versus just doing a naked put. If I do a naked put, I got a 13 delta. I'm going to go a little bit lower delta on this. 510 by 480. I'm going to go a little bit bigger on the, oops. Okay, so this one gets 2 contracts. That's for 340. So 340 to 350 income. Probability of profit is extremely high. I know it's out of ways, but like I said, I'm pretty bullish or stable into the first half of the year. I'm more concerned with how long my expirations get out through like September, October, December 2026. I'm not doing a lot of trades out past that unless it's non-correlated. Okay, I know I just have a couple minutes here, but bear with me. So Pulver alerts, 510 by 480. Or if I wanted to tighten this up a little bit, I can get over $4 on the trade. That's a nice little income trade. I expect to make $400 on the trade. If I do this one, I build in a bit of a profit trap. Now I make 340 to 350 on the trade, but I also increase my profit trap by $1,000 and lower my cost basis. So I'll ask a question. Would you rather own the SPY if you want to take some shares of this, which I'm happy to do, if I own the shares at 450 or own the shares at 460? So if I do this and I accept a little bit less credit up front, I can own the shares at, $450, which is a pretty massive discount. You go into any chart here, go to SPY from all-time highs. We take ownership at 450. From all-time highs down to 450, that would be a 34.5% discount. Could the market pull back? I mean, yeah, the market could do whatever it wants. We could have a 50% correction. But if I took ownership at 35% discount and I dollar cost average into that 50% discount, I'm going to make 100% of the upside. It's that simple. It might take years to do it, but that's a great place to start. So to me, it's just getting started on an income trade. I'm going to go 510 by 480. See if I can grab 350 on this one. And let me Yeah, this isn't too bad. I'm going to go, I like this trade enough. So you might get 350 on this trade. It's probably going to feel like 345 or 340, but let's see. 345 not filling. Let's try 340. Oh, you dirty dog. 338. Filled. All right, trades in. So I'm adding that in. That's a 510 by 480. I do have a profit trap on this one. Here's what the mechanics look like. I'll type this up with the Pulver alert. I have a profit trap of $6,000. It is like trading a naked put. I don't mind owning the shares. If you don't want to own the shares, the way you manage this trade is look at the premium that you pulled in from the 480 put. So it's trading for $5. All right, I'll put this in the alert. If this $5 is trading for like $20 debit, take the loss. If you can't afford to own the SPY shares, then take the loss and close this out for like a $1,000 to $1,500 loss. I don't expect this debit to get that high. We're trading at like a 7 delta. The assignment risk is like 7%. Probability profit is 99.5. Plus, we have a VIX that's over 21 right now. It's hard for the VIX to be sustained at those levels. Okay. So, all right, I'll put that in the Pulver alerts. I got to go here in just a couple minutes. Any questions? So, fresh trade on Pulver alerts coming in hot. I'll type this out. And look, I trade a lot of options. I sprinkle in some currencies. I'm not as heavy on currencies as I once was because 90% of my portfolio is migrated into trading indexes, stocks, options. I do trade a lot of Bitcoin. I trade a lot of gold and silver. I love the futures market, but I primarily use it as a hedge. But I can teach anybody how to trade anything. You want to trade Forex? I do a lot of private workshops. I work with Forex traders, futures traders. Options is kind of my bread and butter because it's made me a better portfolio manager. So I think when you learn how to trade options, you're playing chess. I think you know your risk and reward up front. It's kind of like that, that classic book, Art of War, where you know your enemy. It's like you do all the heavy lifting of the probabilities of the trade beforehand before you ever press enter, and you're not going into any option trade with the uncertainty of like what's the worst case. Worst case scenario for that trade I just posted is that we have a ridiculous correction. I take shares of the SPY at a 34% discount and I work my way through it. I'll do it. But what's likely to happen is I pull in $3.40 and I just make $340 income. And this has to sit there and let 3 to 6 months go by. Okay. All right. Where we are at for the day, just watching intraday. I should have a trade working out pretty well this morning. Put in an intraday trade on SPX right in here. It's now up 70%. So that's looking pretty good for the day. I'm just going to let this one kind of sit. It's $100 on the day. So it should be pretty straightforward. We had prices. We had a wild couple of Thursdays and Fridays. That was a crazy swing for a couple of days. Today seems to be pretty contained. So I'm gonna take advantage of that containment, make a few bucks, and come back and do it again tomorrow. So all right, I'll get that typed up in the A1 Trading Discord for the Pulver alerts. Again, I'll show that final slide. 45% off your Edge Finder, 40+% off Pulver alerts. I'd love to see you in there. You can hit me up. You can ask the team to reach out. If you get the Pulver alerts added in, I'm giving you a $500 bonus course. It's my practical options. I've given that to my family. I've given that to clients of mine just to help you understand. Like, look, here are 13 go-to strategies of how I trade the markets with up, down, sideways. And if you can get your head around a couple ways to express being bullish in the market, look, a bullish market. These slides here. This is taking advantage of positive drift. Positive drift. Positive drift. There's a lot of ways to do it. But if they can compound pretty simply year over year, and by the way, this isn't just because like, well, Chris, this is the greatest bull market we ever had. I mean, to a degree, yes. But you realize that we have had 7 corrections of over 20% in the last decade. So this idea of like booms and busts and bubbles, I mean, I don't want to say bubble. That's being thrown around too liberally right now. But I will say that the market's ability to go up 10 to 20% and go down 10, 20%, it just seems like that's what we have to deal with. So the market's ability to bounce back, the market's ability to have these reflexive rallies, I think that's one thing we've seen for the last 10, 12 years is a lot of V bottoms. But the concerning thing is markets do this. They tend to do this. A market and the stock market tends to V bottom, and then it goes and 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 goes, and then it has either a V bottom and it goes and goes and goes and goes. So the trajectory and the pace and the acceleration, the bulls move way slower than the bears. Okay, where the concern is if we, let's say we take out a low, right? Let's kind of draw out 2025. We were sideways through December, January, February, rolled over in February, March, and April, bottomed hard, pullback, broke the trend line here. This would have been April, May. Once we broke this trend line, it has been nonstop drift. Had a little correction in July to August, right? Little correction in September, little October 10th candle. We hit all-time highs after that, and here we are again. That's how we're at. So sure, does the structure break? Maybe. If this October 10th candle takes, maybe. Broadening patterns are pretty difficult. I'll watch this stuff. If we're greater than the 144, we'll maintain bullishness. If we're less than the 144, be cautious. If we're less than the 200 and things are crossing over, it's not a time to be bullish, right? Have some cash, have some dry powder, but be ready to buy and discount because you're going to be treated well for it. Okay? Don't lose perspective. See the forest through the trees. Okay? These are proverbs and truisms for a reason. Buffett and Berkshire Hathaway, the guy's stepping down, but they're at like 32% cash. It's not an accident. It's by design. They're looking for discounts, and they're probably looking for a lot of stuff that's non-correlated. People have been criticizing Buffett for years by missing out on the tech run. I don't think he cares, because what he's going to end up scooping up is probably stuff that's going to perform really well in the long run because they essentially hold stocks forever. So anyway, all right, I'll let you go for today. I know I went long. I appreciate you letting me be here with you today. James, take it away. Thanks for being with us for this session. We've been looking forward to this for many, many weeks. And again, love to see you in Pulver Alerts, and talk soon. Thanks.
Hello, everyone. Welcome to my segment of the webinar. So my name is Marco from A1 Trading. You may have caught me on the live streams, and this is going to be my segment. So if you have any questions, you can put them in the comment section on the side. So I have the comment section open. But first, I have a presentation prepared for you guys that is going to talk about, well, I'm just going to show you. So here is the overview. This is what we will discuss for today. We're going to talk about the US stock market. We're going to talk about the taco trade. Trump always chickens out. We're going to talk about how Trump loves Mondays. I'm going to show you what I mean. Bitcoin halving cycle and why you should know about it. What will the Fed do in 2026? Because no one knows, but I have some idea. USD is the bottom end. So I'm talking about the DXY. And of course, I have my trading view open. So we're going to talk through with the charts. So DXY is the bottom end. And then I'm going to talk about my favorite idea for the end of 2025 and beginning of 2026, which is selling the Canadian dollar. So let's get started. For talking about the US stock market, we need to talk about artificial intelligence. So artificial intelligence has been the biggest driver of this CapEx spending and this massive move to the upside on the NASDAQ and the S&P in 2025. And in my opinion, the AI story is getting a bit stale. So I think investors are starting to raise questions. Will this massive investment actually pay off? OpenAI is massively in debt. The revenue is not so big. 90% of their users are free users. I'm a free user. I'm not paying for OpenAI. I'm just getting my stuff for free. So the revenue is really low, but they have a lot of debt, and they have a lot of, like, I'll promise you to pay you this and this amount in 26, 27, 28 if you build me these data centers. So here is a bit of a case study. Oracle, September 10th, they partnered with OpenAI, I believe. Their stock shot up 46%. October 6th, AMD up 35%, again, announcing a partnership with OpenAI. AFGO, which is Broadcom, I believe, October 13th, up 11%, but then back to sort of flat after announcing a partnership with OpenAI. What can you spot? Well, this was September, this was October, this was October 13th. You can spot huge reaction, big reaction up, and then break-even reaction. So a joke works great the first time you tell it, but the third time or the fourth time you tell the same joke, it's not going to work as well. That is what you're seeing here. So the AI story is getting a bit stale, in my opinion. Since it is the main driver of the explosion in the NASDAQ, we have to think about it. Spending on AI is no longer bullish. What do I mean by that? Well, this is another small case study on Meta. Meta basically runs Facebook, Instagram, and all of those other cancerous websites. So July 30, they had an earnings call. Meta had an earnings call, and they announced massive spending into artificial intelligence. And I mean massive. The markets initially loved it. So you can see the explosion in the price and just a completely bullish reaction. Well, they did the exact same thing on October 29th. This is October 29th. They announced on a conference call massive spending into artificial intelligence, but this time they had a completely different reaction. See, here we had an explosion to the upside. Here we had a massive sell-off and a massive bearish reaction. That is another telltale sign that the markets and investors are starting to ask questions. Well, why do you need to invest so much money? Can you cover these expenses? Can you cover this debt? What is the ROI? What is the return on investment? No one really knows. So that is a problem. And I would say this is a bearish scenario or bearish reason or a bearish confluence for especially the NASDAQ because it's top 100 technology stocks. And also shout out to Brent Donnelly for these charts. He has a free monthly newsletter, I believe, which goes out on a Friday. So if you want to check this out, if you want to follow him, because he did, let's say, give me an idea of what is happening with AI, definitely give him a look. But let's go a bit further. Let's talk about Bitcoin versus the NASDAQ. So this chart compares the value of Bitcoin to the value of NASDAQ. You can create this chart pretty quickly. I'm going to do it right now. So you jump on the NASDAQ, you click this plus button, you find Bitcoin in the search bar, you click new price scale, and you get a new axis right there. And let's zoom out on the daily chart. Let's zoom out a bit. What can you spot here? If I just align the tops, what happened at the beginning of 25? Bitcoin was the leader when it came to bearish price action. Bitcoin went down first. NASDAQ followed. What is happening now? What happened in October? Bitcoin went down first. Now NASDAQ seems to be coming lower as well, seems to be pulling back a bit. So Nick often says Bitcoin acts as a technology stock. Bitcoin is a very risky asset. I completely agree with him. I view Bitcoin as a technology stock. When the NASDAQ is moving higher, there's a very, very high chance that Bitcoin is moving up as well. So essentially, since both of these assets are risk-on assets, and the markets will keep on buying Bitcoin, but it'll be the first thing they stop buying if they don't feel that they are in a risk-on environment. If they don't feel like the current environment favors a lot of spending on risky assets. So that is why Bitcoin, in my opinion, is kind of the leader and goes down first, because it is the most risky, right? After Bitcoin, you have meme companies like Tesla, like Palantir, like Nvidia, and they're part of the NASDAQ. So when Bitcoin goes down first, the risk on sentiment is starting to be, let's say, lower and lower. And we're starting to go more into a neutral sentiment. That is why it leads, and then NASDAQ follows. That is why here it leads, and possibly the NASDAQ will follow. It's not a guarantee, it's just a theory, but it is something that I'm considering. So that is another bearish case for the US stock market. I'm specifically talking about the NASDAQ, but the S&P should go down with the NASDAQ if I'm bearish on it, okay? Now let me give you a bullish case, which is a quote from Chuck Prince, who was the CEO of Citibank, okay? So a very, very famous person in finance and a very successful guy, I would say. His quote is, "As long as the music is playing, you've got to get up and dance. We are still dancing." What does that mean? Well, that means if you zoom out on the NASDAQ, let's just remove this. So if you zoom out on the NASDAQ, you will see that it's just going up and up and up. And yes, you get some pullbacks, you get some corrections, but overall, we're just trucking higher. In the short term, I would say we are definitely respecting the trend line, if I can paint it right there. So we're definitely respecting this trend line, kind of touching those lows. and the music is still playing. We still haven't broken any key levels. We still haven't had a massive sell-off or a massive meltdown. So as long as the music is playing, you've got to get up and dance. That is the bullish confluence. Right now, me personally, I tried to get in on a Bitcoin buy setup recently. It was a loss, unfortunately. That was my risk on play. So right now I'm being a bit more patient, but if I had to make a decision, I would be more bullish than bearish. Yes, the AI story is concerning. That is true. But also, we still haven't broken any key levels. If we break some key levels, if we break this trend line, or if we go lower with massive force, I'll of course change my mind. So I'm looking at all of these things. I'm looking at all of the bullish confluences, all of the bearish confluences, and I'm neutral to bullish right now, and I'm not in a buy setup. Okay, if anything changes, of course, you'll be notified in the A1 Discord or on the daily live streams on Trader Nick. I just wanted to show you these things because I find them real interesting, and I think you can create a good trading edge by following the current narrative, and the current narrative is artificial intelligence. So the next part is going to be the new president of the United States. Well, he's no longer the new president. That would be Trump. And Trump, I would say, is great for traders. Very bad for the common investor, but great for traders, because we as traders, we can anticipate his next move. He's a pretty easy guy to read when it comes to manipulating the markets. I'm not sure about all of the other stuff, but when it comes to market manipulation, he is pretty easy to read. So there is a couple of things you can do, or that you can trade with Trump's current presidency. These things worked in his first term. They are working now in his second term. Don't miss out on these opportunities because it's very easy. There's a pretty high win rate, and you just need to be quick on his quick with receiving his tweets, let's say. So you need to be on Twitter, you need to be on Truth Social, or you need to be on Financial Juice. All of these options are absolutely free. So it's absolutely free. You just need to be fast. What is the taco trade? Taco trade means Trump always chickens out. Okay. The general story is Trump comes in, makes a crazy tweet, crazy post, crazy announcement, market drops, and then over the weekend, he usually goes back on his word and the market rallies soon after. The last example of this was on Friday, 10th of October. He mentioned that he's going to put massive tariffs on China. Then there was the weekend, and on the weekend he said, I changed my mind, China is good, we're going to do a deal. And he pretty much never spoke about the massive tariffs again. So initially on Friday, there was a massive sell-off. You could have bought the dip because you know about the taco trade and you know he's going to chicken out. And then market opens, explosion to the upside. So that was a pretty good trade. I think Nick actually caught this position, and pretty easy. I was a bit too slow. I'm not going to lie. I was a bit too slow. I didn't even catch his post. That is why I say you need to be quick. So you need to have access to his posts and you need to react quickly. But it's a pretty easy trading edge. The next trading edge is the Trump loves Mondays. So what does that mean? Trump loves Mondays. Well, you have to know something. Trump uses the US stock market as a scoreboard. So if the US stock market is doing well, that means he is doing well, at least in his head. So he uses that sort of as a marketing tactic as well. He says the stock market is up 20, 30% since I took over, and he is very proud of the stock market. So that should tell you that any dip that happens, Trump is going to fight with all of his might to try and push the price back higher. You saw it on Liberation Day. So you saw it basically the massive sell-off that he caused, and then he said he's going to put the 90-day pause, and then the markets rallied. So Trump is going to do whatever he can to keep these markets going higher. Now, something that you can notice during Trump's presidency is on Monday, there's a huge rally in the S&P. So here is the SPX return. I hope it's easy to read. The image is not really high quality. That's my fault, but I'm going to explain it. So this is the S&P return by day of the week by president. You have Bush second term, Obama first term, Obama second term, Trump first term, Biden first term, and Trump's second term. Well, what can you see during Trump's terms? Monday is massively green. Again, Monday is massively green as well. It was green on Monday it was green during Biden as well, but right now it's Trump. So usually on Monday, there will be a massive positive move on the S&P. Why is that? Well, it could be that if the S&P has a bad week, so let's jump onto the S&P because we're analyzing that. It could be that when the S&P has a bad week, a negative week, or a break-even week, Trump kind of thinks about what can he do, what kind of announcement can he do over the weekend to help the stock market, right? So usually over the weekend, he'll make some sort of an announcement, post, tweet, or someone from his team will do the announcement. And then on Monday, the markets will rally. You saw it pretty clearly here on Monday. We rallied up. This Monday, it didn't happen, but we can still accomplish that. So we can still go up during the week. But this is another trading edge. So what you need to know, Trump uses the stock market as a scoreboard. Trump won't let the stock market fall by a huge amount of percent. And Trump uses the weekend to make an announcement to help the stock market. That is why on Monday, you can see the performance of the S&P is very, very positive. So Trump loves Mondays, or the S&P loves Mondays during Trump's presidency. That's what you can take away from this part. So we pretty much covered the stock market. I shared with you most of my, let's say, best trading edges. So let's touch on crypto. Let's talk about Bitcoin. Now, Bitcoin, you pretty much know about it, but this is something that you may not know. This is the Bitcoin halving cycle. So Bitcoin halving cycle is a period that lasts for 4 years. I'm not going to go too deep into what is a halving cycle. You can look it up on your own. But essentially, we have had 3 halving cycles so far on Bitcoin, from 2012 to 2016, from 2016 to 2020, and from 2020 to 2024. And you can see the Bitcoin performance over these 4 halving cycles. This is the performance. We are now in the halving cycle 24 to 28. That is the current halving cycle. We are now here. Okay, November of 2025. We are now here. What can you see that happened in these halving cycles during this period in the halving cycle? Bearish, bearish, and again bearish. So we are now in the bearish part of the halving cycle. It becomes bullish again in around November 2026. Why am I telling you this? Well, this is an extra bearish confluence that you have to consider when looking for buy setups on Bitcoin. That is why I'm a bit hesitant to get into Bitcoin. And Bitcoin recently broke some key levels, in my opinion. So first, it broke this pretty strong level of support right there. And it broke a pretty key trend line, I would say, right there. So that is why I also tried to get in on a position. I thought this level was going to be heavily defended, but it did not work. So Bitcoin seems to be very bearish. Also, there's another trend line you can paint if you're into that right there, which has also been broken. So pretty bearish price action from Bitcoin. And then we notice that we are now in the bearish part of the halving cycle, right? So if it doesn't make sense, just look at this line. It is the current halving cycle period. And we are now in this bearish part where the price usually goes down. And then it rebounds in November 2026. So this whole thing is a period of 4 years. I hope it makes sense. If it doesn't, there's going to be a recording. You can watch it again. You can think about this. It took me a couple of tries to understand this as well. So don't feel bad if you are not sure what this means. That's it for crypto. That's it for Bitcoin. That is why I currently am being patient on Bitcoin. I do have some Bitcoin as a long-term investment, but we have broken the key technical level. We're in the bearish part of the halving cycle. So I don't really want to buy right now. I want to be more patient. Next thing I want to comment on is, what will the Fed do in 2026? That is a big question. The Fed pretty much controls the US dollar, or it doesn't control the US dollar, but there's a huge impact on the US dollar, and the US dollar is the most important currency in the world. Everything is quoted in US dollars. Oil, gold, silver, copper, Forex, pretty much most Forex pairs are viewed against the US dollar, not against the euro, not against the yen, but against the US dollar. So the US dollar is the absolute most important currency, and we have to know what is the path of rate cuts for the Fed. Well, a very easy thing you can take a look at is the Fed Watch tool, free website. Just type Fed Watch tool, this will pop up. So for 2026, if we click on the final meeting of 2026, you can see that the target rate is 300 to 325 basis points. We are now currently running 375 to 400 basis points. So essentially in 2026, we have a couple of rate cuts already priced in and scheduled by the Fed. The Fed releases future projections, which signal when they will do rate cuts or when they believe they will do rate cuts. So nothing is guaranteed. It's all still, let's say, tentative, but these are the guidelines. So these are the guidelines for the rate path. Okay. Now, that's what is priced in, but I actually believe that the Fed will be more hawkish than expected. More hawkish means a higher US dollar. So I'm bullish on the DXY. I personally believe that the DXY could continue going higher. There's a high chance for it to continue going higher, and I believe that possibly the bottom for the DXY is in right there. Now, why do I think that the Fed is going to be more hawkish than expected? Well, first you have to look at December. We had a 90% chance that a rate cut will happen in December. Now it has fallen all the way down to 42.9%. So the percentage keeps falling and falling and falling, right? As you can see here. So rate cuts are no longer guaranteed in December. Now, each time that there was a rate cut in, let's say, the 17th of September, you can take a look, see, they cut rates. And then again in what is this, 29th of October, they cut rates. Each time the dollar went up. How is that possible? What is the logic behind this? How can there be a rate cut, but the dollar just keeps going up? Well, it is because when you get a rate, when you get an interest rate the same as the forecast, then it's all about the future projections. Then it is all about the forward guidance. Forward guidance is all that matters. And in both of these meetings, Powell came out and he was hawkish. So they made the rate cut, but Powell was hawkish, which goes against the rate cut. And each time he mentioned inflation is an issue. We're looking at inflation. Inflation looks a bit problematic. December rate cut is not a guarantee. That's what he said on the 29th of October. December rate cut is not a guarantee. And this is sort of becoming a common phenomenon that you can follow as a trader. So if they do plan to cut rates, and maybe they even cut rates, there's a high chance that Powell will be hawkish and that the dollar will actually move higher. Okay. So it's not about the number. If the number comes out as expected, it is all about the forward guidance. Now, why is Powell concerned? He is concerned because the CPI in the US for the US dollar is way above target. CPI is 3%. The target rate is 2%. So inflation is running hot. Inflation is running above target, and people are starting to ask questions. Isn't your target 2%? How can you cut interest rates if the current inflation is 3%? What are you doing? Why are you cutting rates? The current GDP in the United States looks healthy. Massive spending going on, massive capex spending, positive GDP. Tariffs are no longer in the spotlight. Unemployment rate is not bad in the United States. It is actually pretty good. It used to be 6%. Now it's 4.3%, and it's being flat. It is not rising like it is in Canada. Check this out. Canada, very, very bad numbers. But we're focusing on the US dollar now. So people are starting to ask questions. What will the Fed do to actually lower the inflation? Because 3% is not a healthy mark. 3% is way above the target. And that is why I believe in 2026, Powell and the Fed will be more hawkish than people may expect. As I told you, it already happened 2 times, here on the 17th, here on the 29th. It's probably going to happen in December. If we get a rate cut at all, we may not even get a rate cut, which is very hawkish in and of itself. I can show you. So Fed interest rate, Fed interest rate. So I use Trading Economics, free website. So I go to the 5 years, and basically, currently the Fed is on a path to cut interest rates. If they make a pause, that will definitely be hawkish. So that'll definitely be hawkish, and that should be bullish on the DXY, right? So that is what I believe is going to happen concerning the Fed. I think Powell will be out in 26, so Powell will no longer be head of the Fed, if I'm not mistaken, but it doesn't matter. It's 12 or 13 people. They're voting. It's not all Trump puppets. There is one Trump puppet that he installed recently, but the rest of the gang, they should be neutral. They should be people that are not impacted by Trump's decisions or Trump's will. So the Fed acts as a completely separate entity. There are many members. There's a vote being cast. Should they raise rates, keep rates the same, or cut interest rates? And I believe they will be more hawkish since inflation is running hot, while the GDP is looking healthy, while the unemployment rate is looking okay as well for now. If anything changes, if the NFP starts becoming negative, so if we go to the labor data, NFP is in a downtrend, but you have to know this is just, these numbers are crazy. These numbers are not sustainable. You cannot keep getting 272,000 every single month. So yes, the numbers are becoming lower, but they're still positive. They're still not in the negative territory, and the US economy is still looking pretty healthy. Okay. Next, I want to talk about the US dollar. We pretty much talked about it already, but let's focus on the US dollar. Is the bottom in? This is an old picture, by the way. Right now, we have had this correction on the daily chart. So is the bottom in? I believe it is. So I believe this is the bottom. I don't think we're going to go much lower than this level by the end of 25 and the beginning of 26. I cannot forecast all the way to end of 26 because I think that's just silly. But end of 25, beginning of 26, I think we go up. I think this is the bottom. You have to ask yourself, yes, there was a massive sell-off at the beginning of 2025, but why did the sell-off happen? So what was the narrative? It's all about narratives in Forex. The narrative was Trump is coming in. He is doing crazy tariffs. He is doing some unexpected stuff. He's a wild card. We have to jump ship. We have to sell the US stock market. We have to sell the US dollar because Trump is such a wild card that we just do not know what his next move will be. So that was the reason for the correction. Hedge funds, pension funds, investment funds, they all over the world, they kept selling US dollars. That was the narrative. Then in July, things started to calm down. We started to become flat. We started to become neutral. The selling was done. So for another sell-off like this to happen, fundamentally speaking, for another sell-off to happen, you need another very strong narrative. So you need another event like we had in 2025, beginning of 25. You need Trump to come in again and slap on massive tariffs or do some crazy announcement that no one expects, and people then again start jumping ship and running away from US assets and the US dollar. Is that currently happening? No, it's not. Tariffs are no longer in the spotlight, and Trump seems to have calmed down at least a little bit. And of course, he would like to see the stock market go up, not down. I think he kind of noticed when he crashed the stock market the first time that he just can't do these crazy announcements, crazy tweets, because he's going to suffer. Okay? And we have re-elections coming up soon, I believe, in the United States. So, of course, Trump wants to pump up the stock market like crazy. So for the DXY, that narrative is gone. The massive selling is gone. And also think about it. To sell the US dollar, it's a pretty expensive proposition. It's negative swaps, right? We can take a look at the Edge Finder. We can take a look at the carry trade scanner. If you sell USD JPY, look at what is the interest rate divergence. Look how expensive that position is. Yes, if you buy, you will receive swaps. But if you sell, every single day you will pay negative swaps. And by the end of the year, if you sell the US dollar, your portfolio may lose around 4% of its value just by selling the US dollar, just by being short on the US dollar. So being short on the US dollar is a very expensive position, very expensive proposition. And I don't think hedge funds, pension funds, investment funds want to be long-term short on the US dollar. I don't think that is what they want, because it's very expensive just because of the high interest rate, right? So that is another reason why I just don't believe that the DXY goes down. And that is another reason why I have a bullish view on the DXY, okay? I also remembered now I have to talk about the Santa rally. So just not to forget, when talking about the stock market, that is what I wanted to mention. You have another bullish confluence, which is the Santa rally. November and December are usually very, very bullish months for the stock market. Don't believe me? Well, if we can jump on the Edge Finder, we can go to the seasonality, monthly, NASDAQ, November, December, absolutely bullish. S&P, or is it SPX? I think it's SPX. SPX, massively bullish in November, massively bullish in December. So seasonality is very bullish. Santa rally is real. Company buybacks have started again. Okay, so there was a pause for company buybacks, but they have started again. People are massively spending at the end of the year. Portfolio managers, pension fund managers, all of those investment managers, they want to pump up their portfolios by the end of the year. They want to be heavy into the US stock market, so they just buy like crazy in November and December. So it is a very, very common seasonality pattern. And another reason why I am bullish on the NASDAQ, bullish on the S&P. Again, another bullish confluence that is important to mention. So we pretty much covered the DXY. We pretty much covered the dollar. Now, let me give you my favorite trade idea of 2025 and 2026. That would be to buy USD CAD or sell the CAD in general. Now, I personally believe, because I mostly trade Forex, so I mostly trade currencies. I personally believe that the CAD is the weakest currency pair right now. Okay, so let me tell you why. We have all of this data. I know it's pretty small to see, so I'm just going to jump on the Edge Finder and show you. I'm looking at the long-term data. We can also take a look at the short-term data, but it is pretty important to distinguish long-term from short-term. So let me try to explain. This is the short-term data. It all depends how you are trading. But in the short term, these are all of the last numbers that came out for Canada, last numbers that came out for the CAD. We can see most of them are bullish. So most of the numbers are actually bullish in the short term. GDP, manufacturing, services, retail sales, CPI, PPI, unemployment rate, and employment change. So yes, in the short term, the CAD is catching a bid, but I'm looking at the long term. For that, I'm looking at first the GDP, the trend of the GDP. Let's take a look. This is it. This is from January 1st, 2024 up until now. Negative GDP, looking very, very bad. So GDP is all over the place. It doesn't look healthy for Canada. Labor market, unemployment rate for the CAD. I already showed you this, and it is looking very problematic, rising. Can you see it? So there's a clear uptrend in the unemployment rate. Current unemployment rate is 6.9%. So yes, the latest number came in better than the last number. So that is why the CAD is catching a bid. But overall, if you zoom out, we are still on a path where the markets just keep on going, or this chart keeps on going higher. It was 5.75 in January 24. Now it's 6.9%. Would you want to live in Canada with this unemployment rate? I don't think so. So Canada is facing some big problems. Inflation, CPI for the CAD. It is, in my opinion, above target. The target inflation rate is always going to be 2%. We are now at 2.2%. Looks like this recently came out. So interesting. We were at 2.4. Now we are at 2.2. So interesting that inflation is still going down from the previous number. But overall, it is still kind of above target. So you have to know, for the central bank to stimulate the GDP, to stimulate the unemployment rate, it has to cut interest rates. Well, what is the negative of that? There's always an action and a reaction. You cannot there's nothing in life that is free. Okay, so to get something, you need to sacrifice something else. Well, in this case, to improve the GDP, to improve the unemployment rate, you need to sacrifice higher inflation. Well, if they do that, if they cut interest rates, inflation goes up. And it's already above target. That is called sort of a stagflation scenario. Stagnating growth and higher than expected, higher than the target inflation. So that creates big problems for the Bank of Canada because they're not sure. Should we pause with rate cuts? Should we cut interest rates? They're just not sure. The numbers look problematic. And stagflation is never bullish for the currency. Stagflation is always bearish for the currency. It reduces the demand for the currency, and it is just a bad thing overall. The last thing is the housing prices in Canada. So I built this chart for ChatGPT. Super easy. You just give it a couple of instructions and you say paint a graph, or basically paint a chart. And this is the chart that I got from ChatGPT. This will soon also be in the Edge Finder, I believe. Nick told me that he will soon implement housing data in the Edge Finder. If you already have the Edge Finder, you will get it for free. And I think it's going to be great. It's a great confluence for buying or selling currencies. So this is it. This is the Canada housing prices from 2000 to 2025. Okay. And you can see there was a peak in 2021, and now we are in a downtrend. So the last 5 years, we have had bearish price in the housing market. That basically reduces the demand for the CAD. You as an outside investor, let's say you are a real estate investor. Let's say you are not from Canada. Let's say you're from the States and you want to invest into Canada. Well, you see this chart and you say to yourself, well, maybe Canada is not the best place to park my money into real estate in Canada because the prices are falling. Let me wait a bit more and then I can get things a bit cheaper. And so to buy a house in Canada, you need the Canadian dollar. So it's all connected. If there is less buying of housing in Canada, the demand for the CAD goes down as well. The price of the CAD goes down. It's all connected. Very logical, right? So housing prices are going down. CAD should go down as well. Pretty easy, I would say. So now you have 4 confluences that are all telling you to sell the CAD. And I don't have one bullish confluence. I don't see anything that is going to tell me buy the CAD. I mean, I can look at the short-term data if I want to structure my trade for the very short term. And yes, I can see outperformance in the short term, but in the long term, it's all bearish. It's all pointing bearish. So my favorite position for the end of 25, beginning of 26 is still buying the US dollar CAD. As I told you, I'm pretty bullish on the dollar. I think the bottom is in. I think the massive selling is over. I think it has been sold and sold and sold, and we're not going to sell anymore, or the markets are not going to sell anymore. And the CAD, I told you, relative to other currencies, is the weakest currency. And what you must know, it's all about relative performance. How is the dollar doing relative to the CAD? So the dollar doesn't even have to get rock star numbers. It just has to get better numbers than Canada. Currently, it's definitely doing that. So USD CAD is in a pretty healthy uptrend, respecting the 20 EMA, right? So respecting the 20 EMA, moving above it. I took a position on the 28th of October, almost got stopped out. Fortunately, I didn't. Position was running some nice profit, and then unfortunately it sold off and went back to break even. Now it's running just a little bit of profit. Am I concerned? I'm not, because the fundamentals, long-term fundamentals, are still bullish USD CAD. We are still respecting the trend line. So fundamentals are still bullish. Technical analysis is still bullish on this chart. Key levels have not yet been broken. I think I'm in a good position right here. I think the trend line should keep getting respected. And my favorite thing about this trade, it is positive swaps. So as long as I keep holding this position, I will keep receiving positive swaps. And you can check that in the Edge Finder. If you go to the carry trade scanner, you type in USD CAD. See, USD CAD. When do you receive swaps? You receive swaps if you buy. Carry direction, buy. You can see the interest rate divergence. So if I'm going to be in this position for the next 2, 3, 4, 5 months, I don't care. I'm just going to keep holding it because every single day I collect positive swaps. It's much better than, let's say, being in a buy position on silver on the Nasdaq through CFDs and paying negative swaps. So I love this position just for the swaps. The longer I can be in the position, the better, if that makes sense. So yeah, that is my favorite position. Of course, this is not financial advice, but for me, the game plan is just buying dips. As the price keeps going higher, you don't want to buy the highs, of course. You don't want to buy that. You want to get in on the dips. You want to get in when the price is close to the 20 EMA, because the 20 EMA acts as a nice dynamic support. So see, I got in right at the 20 EMA instead of buying the highs, of buying the top. Hope that is interesting for you guys as a trade idea. Now, something I haven't put into here, but something I definitely want to discuss is the metals market. So before we go to the Q&A, I want to quickly comment on the metals market, gold and silver. Now, I'm going to cover silver because I have a trade running on silver, but I have pretty much the same opinion on gold and silver. So we have had a massive uptrend this year in the metals market. This year, the metals market and the stock market have been just blockbuster, massive positions. If you zoom out, massive uptrend. Forex has been a bit slower. I'm going to admit that. So the volatility in Forex has been a bit lower. Forex has been a bit slower, but that's why we diversify. So during the slow periods, you can trade. If Forex is slow, you can still trade gold. You can still trade silver. You can still trade the Nasdaq or the S&P. That is also what most professional traders do. Like the professional traders that I met, have worked with at a trading floor because I did an internship at a real prop firm. And the professional traders that I have read about in Market Wizards, they all trade everything under the sun. If they have a trading edge on something, they are going to trade it. because they know that the trading edge is universal. If you know something that 95% of other market participants don't know, why wouldn't you use it? Why would you limit yourself to, I'm only trading the euro dollar, I'm only trading the NASDAQ, I'm only trading gold? Well, good luck with that. You're going to sit on your hands for 3 years in some cases. So if you have a good trading edge, if you have received or found out a piece of information that 95% of other market participants don't know about, use it, and you can make profits even when your preferred asset class is not doing well. So silver, massive uptrend. I have been trying to get in on a pullback for months now. I missed out on an entry because I was too slow on the 29th of August, which would have been a massive runner. So that is still a bit painful, I'm not going to lie. But recently, we had a nice correction on gold and on silver. Pretty nice correction right here. How big is it? On silver, it was 16.39%. That is exactly what I was looking for. I was looking for a correction. I was looking for the markets to shake out the weak hands, to shake out the weak buyers, and then we can continue going higher. So we had the correction. We then went a bit flat. We had a nice breakout, nice bullish candle right there, which broke out of this small range. And then we sort of exploded to the upside. Now I got in on a buy position on the 10th of November, which was a trade signal as well, if you're in the A1 Discord. And let me list all of the confluences of why I took the position, because I think that will best explain my thinking. So first confluence, massive uptrend. Just rock star year for gold and silver. Second confluence, we have had a pullback. The weak hands have been shaken out. I'm not buying the top, which is something I definitely don't want to do. I don't want to get in at all-time highs. I don't want to be left holding the bag, if that is the expression. Third confluence, we had a small range. We broke out higher. We were above the 20 EMA. Fourth confluence, Edge Finder was bullish. Very, very important. Top setups. On silver, the score was 9. So the score was 9, which was very bullish, I believe. That was a really good confluence. And the final confluence, the nail in the coffin, was a trading edge that you have most likely heard about, and that is buy the rumor, sell the news. Very easy. Buy the rumor, sell the news. The rumor on Monday was that the US government will soon reopen. Okay? The US government will soon reopen. That was Monday last week. Silver exploded higher because of that rumor. How is that bullish for silver? Well, once the US government reopens, the liquidity tap opens with it. So the money is again injected into the economy at a rapid pace. Okay. You also have Trump's big, beautiful bill coming in 26. So all of the spending, all of the money printing, all of the loans being created out of thin air resume. What does that mean? Inflation goes up. Dollar loses value. Your cash, your hard-earned cash loses value at an even higher rate than 3%. Trust me, inflation is much higher than 3%. They are printing a ton of money every single month, and the inflation is more like, I don't know the exact number, but it's more than 5% for sure. So this doesn't tell you the whole picture. Anyways, what can you do to protect yourself against inflation? You can buy gold or you can buy silver. That is exactly why on this rumor of the US government reopening, investors got scared of more inflation and they said, let me protect my portfolio. Let me buy a bunch of gold. Let me buy a bunch of silver. What happened on Thursday? We got the confirmation. We got the news from the US House that they're definitely going to reopen the government. What happened to silver? Silver sold off. So it was a classic buy the news, buy the rumor, sell the news scenario. Fortunately, I took 50% of my profit right here on the top of this candle, right near the all-time high. That was also a signal in the A1 Discord. So took 50% off, and I still have 50% running on silver. Why didn't I close the full thing? Because I think this is still a good position. I think this is still a good discount overall. I'm still bullish on silver. Edge Finder, top setups, it is also still bullish on silver. So I don't see a reason to close the full position because I think this has a high probability of continuing the trend higher and moving. I'm just going to move my stop loss below the swing lows. So that is the game plan. I will trail my stop loss below the swing lows if it does go higher. If it wants to stop me out, then silver can stop me out. But as I mentioned, I think this price level and this stop loss position is pretty effective in this area and according to the current fundamentals. And yes, it is still true that the US government, once it reopens, and it has reopened, the US government will do massive spending. And the dollar is just going to keep losing value relative to, let's say, holding gold, holding silver, holding stocks, holding real estate, and stuff like that. Okay? So that covers my presentation. If you want to join the signals, if you want to get signals from me, there's a 40% off discount using my code, which is Marco. This is a Black Friday deal. This is the biggest discount for the whole year. And it's not just about the signal. So yes, you get levels, buy, stop loss, take profit, you get everything, but you also get the exact reasoning of why I took a specific setup. Why am I buying? Why am I selling? And you get screenshots of those exact reasons. So the goal of the signals is not for you to copy them and make money. Yes, that's definitely the first goal. But the main goal, I would say, is to teach you how we are thinking. How are we structuring our positions? Why are we buying? Why are we selling something? So we want to teach you through the signal so that you can start developing your own trades, your own trade ideas, and assembling these confluences. Trading for me is all about looking at many pieces of information and assembling a puzzle. This is bullish, this is bearish. I have 4 bearish confluences. I have 4 bullish confluences. I have 1 bearish confluence. Is this trade worth taking? Can I get a positive reward to risk on this position? Yes, I can. Take the trade. No, I can't. Don't take the trade. So it's not that hard. It's actually pretty simple, but you need to put in the time and you need someone to learn from. The most effective way to learn to trade is to shadow someone. It is to find a mentor or find a community of like-minded individuals or successful traders that can teach you, that you can sort of copy and then learn for yourself how to trade, how to structure trades, how to structure positions. The biggest reason why traders fail, or one of the biggest reasons, is because they find an unprofitable mentor. They essentially find a scammer and they never have that main person to learn from. They never have the right mentor to guide them through the markets. If you have the right mentor, your time to success goes down drastically. That is why the most effective way to learn to trade, the people that learn the quickest are the guys working at real prop firms such as SMB Capital or at investment banks. Why? Well, because they spend 10 to 12 hours every single day in person working with real traders. So yes, that is the most effective way, but this is pretty good as well. So now it is time for questions. Let me look at the comments. We still have 5 minutes. Okay, let's see. Hey Sluggy, what's up? Constant boom bust cycles. I was talking to someone saying the same thing. Yes, definitely we have cycles in the stock market. But I just believe under Trump's presidency that he wants to see the stock market go up. He's going to do everything in his power for this thing to go up. Again, yes, you can have the 2008 financial crisis. Again, you can have a correction just because people don't want to buy anymore. And essentially, it can happen, but I just think that this looks pretty bullish. Key levels haven't been broken, and we are respecting this trend line. So it looks pretty healthy still. I still think we're kind of in the boom cycle. Hey, Oatmain Benchiha. Hopefully I pronounced that correctly. Might be too late to short the CAD. I wouldn't agree. I still think it is a high probability play. Hey, Ballout, what's up? Music is still playing. Margin call reference from Marco. Yeah, it's a pretty well known quote from Mr. Chuck Prince, and it's so true. You can be a bear, you can be a perma bear, you can be Robert Kiyosaki, and you can just call the top every month, and you can say this thing is going down, and you can keep on selling and shorting. That's just gonna lead to a blown account. So you will just blow your account using that approach. The way to steadily make profits is to just get in on the pullbacks. So keep taking small profits out of the markets, keep jumping in on the pullbacks because the music is still playing and the markets are going up. Okay? Even if there's a bubble, which in my personal opinion it is not, markets can still stay irrational longer than you can stay solvent. Exactly. So the markets can just keep going up, even if all of the fundamentals point to bearishness. The markets can be very, very erratic and they can keep going up. I think Michael Burry from The Big Short, he was short on the housing bubble for 2 to 3 years before the bubble actually popped. So he was early to the position by, I think, 2 years minimum. I think, if I remember correctly from the movie. Okay. DXY to 95 because it went down from 110. I think DXY goes up. Canada will recover. Of course, Canada will recover. They're just not gonna cease being a country. But so far, the data is pretty bad, and USD CAD still has a lot of room to go up. It was already at these higher levels at 1.44. So I think there's a pretty high chance we go back to those higher levels. It's not like calling Ethereum, it's not like saying Ethereum is going to go to, where's Ethereum? Ethereum is going to go to 20K in 2025. No, I'm just saying USD CAD could definitely go to 1.43 or 1.44. It already visited those levels. So I'm not calling for some crazy highs. Marco, when Powell cuts this thing, is gonna go to 95. His term ends. Yes. Mirren is the Trump's puppet. Yeah, the name is Mirren. That is correct. So thank you for reminding me. But he's just one, and I think there's at least 12 members in the Fed. So don't think that the Fed is crazy. Don't think that the whole Fed is just bowing down to Trump. There's many rational people in the Fed. Mirren is just one of the guys. So the Fed is gonna do the smart thing. They should do the smart thing because it's smart people working at the Fed. That is it. My time has ran out. Thank you guys very much for watching. If you're interested to join me at day one, you have the 40% discount. And good luck in the markets. You can catch me tomorrow on the live stream. So thank you. Goodbye.
Hello. Can you hear me? That should be okay. I think I sorted it. Just let me know in the chat, please, before I start talking too much and go too far into this. Should be fine, I think. Are we good? Good? Yeah, sweet. Okay. So what I was saying was, first of all, hello. Hope everyone's well. I've had a crazy lineup today. Some really, really good traders, and it's been some great topics. So what I want to do before we get started is, can you just drop in the chat how well you understand economics? 10 for like you're an expert, you pretty much know everything, or everything you need to know anyway, and 1 if you're like an absolute beginner. Because the reason I'm asking you to do this is because I want to make this not just me talking at you and telling you what I'm expecting, but I want to, sort of teach you and try and make it well, maybe not interactive, but sort of educational as well, as much as possible. So we've got an 8 and a 1. Sweet. Okay, so we've got different ends of the spectrum going on here. Anyway, let's get started then. So for those of you that watch my segments on Nick's stream frequently, you might know that I 6-7. You might know that I talk a lot about why I hate the UK. Oh, well, not hate the UK. That's the wrong way of saying it. Why I hate the situation the UK is in, and why I'm such basically a perma-bear. Every time on stream, I'm always telling you I'll explain it at some point. I'll do something for you to really explain to you why I think that. I haven't got around to it, but now I have, and that's what my segment is about. So I'm going to be breaking down basically everything that's going on in the UK, and we'll lead into some trade idea. We'll go into trade ideas and how we can trade around this towards the end of this presentation. It's only about 10 slides. Don't worry, it's not going to be super long and boring. So UK macro and GBP outlook for it's basically first half of 2026. So basically first and second quarter of 2026 is kind of where I'm focusing here. So again, for those of you who aren't really massive macro or fundamental or economic people, I've got a cheat sheet here. It might be a bit late. I know you've already had 3 guests on talking about trades and economics and things. The reason I've done this is because it's very important to understand, not just for my segment, but if you're a trader in really any aspect, you should understand, or at least have some sort of idea of what these terms and phrases and words mean. So I'm not going to go through all of them. Print screen it if you need to. Again, it's just sort of educational purposes that this is here. So let's go first of all into the UK macro outlook. So we've got pretty poor growth, and I'm going to switch between the edge finder and things. I'm not going to sit here and make you look at these tiny pictures. But basically what we've got is very, very small growth within the UK. So we go over here to economic data. We have a look at the GDP. We go to UK or GBP. We can see that the GDP reading has actually come out even worse than what it was when I was making this, which is, I think it was last week I put this together. So at that time, you could see GDP came out at 0.1, which is already pretty poor. Since then, it's come out at negative 0.1. So already we've got a bad start for the UK going into 2026. So we've got slow or low growth, I should say, not slow. It's poor growth. Now, what we've also got is a couple of different things with inflation. So inflation is elevated again. I'm going to keep switching back and forth. I do apologize. It might be a bit frustrating to watch. So the inflation or CPI year on year in the UK is what we do basically call sticky. So sticky doesn't mean that it's basically the same number repeating like we do have here. Sticky can mean it's sort of within the same range but climbing. That could also be defined as sticky. So like this 3.4, 3.6, 3.8, 3.8, 3.8, that can be defined as sticky. So we've got sticky inflation in the UK paired with low growth. Now keep in mind, most central banks, and when I say most, I'm talking specifically about major central banks, so not places in like, parts of the world we don't trade, like miners and emerging markets type central banks. I'm talking specifically like Europe, UK, America. The target inflation rate generally is 2%. So we're way above that, 1.8% above our target. Again, low growth, and retail sales are not doing hot. I'm not sure if we've had a new retail sales print since. Let me just double check. Here we go. Yeah, no, we've not. So retail sales are doing pretty much nothing. They peaked at 1.7 back at the start of 2025. Since then, it's just been a slow degradation down, peaked or low down here at 0.4, rocketed down to negative 2.7, climbed back up. And since then, we've just not managed to really do anything. We did slightly beat the forecast, which was at negative 0.2. So I suppose that's a slight thing in the right direction that we did beat forecast. But overall, still very poor data. So this leads us into some stagflation problems. So we've got GDP growth is below 1%, inflation is still above target and sticky. We've got fiscal policy remains restrictive, no productivity boost, consumer demand and business confidence are weak. This creates a classic stagflation setup. We've got limited policy room and limited optimism. So if growth is weak and the policymakers actually, let me just go over here again. Sorry, bear with me. So if you are a policymaker, so someone that's in the central bank, and you see growth looking like this, so you've had absolutely flat growth in for the September reading, you've had +1 here, and then -1. What's your immediate thought to do? Well, it might be to cut rates. And the reason you would want to cut rates in a situation like this is to stimulate growth. So when we cut, oh, sorry, not when we cut, we're not doing anything. When a central bank cuts rates, it makes it cheaper for businesses and consumers to borrow money. So what that does is, obviously, if you can borrow money for cheaper and easier, you can spend it. You've got more money to spend and put back into the economy, boosting growth, basically boosting the economy. However, sorry, I went back there. However, when we look at CPI, how can the Bank of England cut rates right now? Well, they can't. So the general way you want to look at hiking and cutting rates by a central bank is it basically follows whatever inflation and the labor market are doing. If inflation and let's say unemployment are going down, you might expect rates to come down as well. Vice versa, if inflation's going up and unemployment's going up, you might expect, sorry, that's the wrong way, inversed. Anyway, I'm going to move on because I'm getting my brain in a tangle there. So hopefully you got what I was trying to say, though. The Bank of England is in no position to cut rates, to hike rates due to the sticky inflation, but they kind of need to because of the low growth. So bad situation there. So next slide brings us to the yield gap is closing and the sterling is losing its carry. For anyone that doesn't know, sterling is basically what we call the pound or the GBP, just different words. So the UK, the UK-US 2-year yield spread is compressed from roughly 70 basis points in March to the low teens. I'm not sure why I put low teens because it's actually 16 basis points by November 2025. So markets price a Bank of England rate cut before the Fed. Now, keep in mind, if we're thinking back to what's happened or what the Fed has been doing and sort of the trajectory that they've been going on, we had a couple of mixed things, really. We had, obviously, we've got the US government shutdown, so we've got limited data there. We have got the SEP that did project rate cuts or signaled rate cuts based on their projections. We had the dot plot that also signaled rate cuts. Then we had Powell come out and say that it was a risk management cut. The previous cut was a risk management cut, and now it's seeming like the US isn't going to cut rates, or the likelihood of the Fed cutting rates in December is getting lower and lower. So that does also contribute to this idea that the Bank of England could end up cutting significantly quicker than the Fed. Now, what's interesting is pound dollar tends to underperform as the UK US 2-year spread approaches zero. So what this means, and actually a key to this, is approaches zero. It doesn't have to be at zero. So we don't have to see this spread here at nothing for this idea to work out. It can be just lower. It could be 10, 5, whatever. But this spread lowering is a big problem. So when, hold on, let me change my mouse back there. When the UK US 2-year gap approaches zero, pound dollar typically underperforms over the next quarter. So this is something we can keep in our notebooks, in your journal, on your trading view chart. I don't care. But this is basically a if Y then X situation. So if we do see the spread between the US and the UK decreasing and continue to decrease, going towards zero, then we would mark out the next quarter and potentially look for shorts on pound dollar. Not investment advice. I'm not sure I will do that, to be honest. But again, good to keep notes. So the near-term implication is limited upside for sterling beyond current levels unless the UK yields re-expand. This is for you guys. Watch the UK US 2-year yields 0 to 10 basis points. So if that spread is anywhere from 0 to 10 basis points, fade, which means basically counter trade, pound dollar strength. So if the pound dollar, actually, let me rephrase that before I say anything. If this spread is from between 0 to 10, and we see pound dollar rally, it's a relatively safe bet to fade that move, basically sell into strength. Again, not financial advice. I'm not telling you to do that. I'm just saying this is a good thought process. And then speculative flows rotate towards US dollar and euro. We've got a note down here from UBS Macro. So they say sterling strength will be difficult to sustain once the Bank of England begins its easing cycle. So we're not just sitting on a YouTube stream and I'm sitting here showing you some pictures and saying this. There is real institutional backing to this as well, which is actually one of the reasons I'm so bearish on the UK, because there's a lot of increasingly bearish talk coming through the sort of smart money wire, if you will. Sorry, 1 second, I need a drink. So persistent trade deficits reflect weak export competitiveness. The UK runs a consistent quarterly trade deficit of roughly 29 billion over the past year. Now, the UK has been running in a deficit for a little while. I'm not sure how long, but I'm fairly sure I checked their export to import ratio last year, and it was negative then as well. So this isn't a new problem, but it is a weight on the economy and a weight on the currency. Services surplus cannot offset the goods imbalance. Persistent trade gaps raise long-term depreciation risk if capital inflows weaken. Until this deficit narrows, sterling rallies remain capped by the balance of payments constraint. So basically, I'm gonna try and explain in a very simple way. So let's say the UK obviously imports and exports different things. So a country may import, I don't know, let's say copper, iron, whatever it may be. They import things. They also export things. So let's say you're X country, I'm Y country. You've got copper, I want copper, but I've got wheat and you need wheat. So where that's our imports and exports dynamic. Does that make sense? So that's the simplicity, obviously the dumbed down version of imports and exports. However, the problem there is if I am paying you more for your copper than you're paying me for my wheat, then I'm running a deficit. I'm not making enough back. I'm losing money. Does that make sense? So that's the basic problem that the UK's got right now. So what does that leave us with, or what does that leave the UK with? Well, if they're losing money essentially with their import exports, then where is the money coming from? Well, largely from foreign investors, of foreign capital. However, however, if we start losing the foreign investors and foreign capital due to things like yields and instability with the political system in the UK, then we're going to be in some serious trouble, or the UK is going to be in some serious trouble. If a country buys more from the world than it sells, it must borrow or attract investment to fill that gap, which is obvious. We've already discussed that. If capital inflows drop if capital inflows drop, the currency becomes the release valve. So what that basically means is if inflows are slowing down or stopping, the way that's going to be expressed is through the sterling. And again, that could be a bit of a bloodbath. It's not going to be, maybe bloodbath isn't the right word, because it's not going to be like a massive bearish red daily candle that goes 1,000 pips. It'll be a slow bleed, and all of this stuff is just it's just contributing. There really isn't very much that is helping the UK right now. There are a couple of things that we might move on to later, but right now this is my bear case for the UK. So the next problem is specifically London. This isn't the UK, because remember, London is the sort of financial capital of the UK. So London's capital markets are shrinking, and they're shrinking very fast. So London raised only 0.25 billion, which I think is 250 million. I could be wrong. I'm not great with numbers like that, but I'm fairly sure it's around 250 million in IPOs during 2025. This is the weakest in 30 years. So we can see over here, just last year, the UK was in 10th place, which still isn't fantastic, but at least we're in the top 10. And this was 0.9 billion, so almost a billion. 1 year later, we are 23rd, with basically a quarter of what we had last year. So the UK has dropped out to the top 20. Fewer IPOs lead into smaller FTSE inflows. So for those of you that don't know, the FTSE is basically like the S&P, but for the UK. It's the top 100 companies in the UK. So smaller FTSE inflows lead to a structurally lower GBP demand. Capital outflows from the UK equities, capital outflows from UK equities directly weaken portfolio inflows that normally support the pound. So again, this is all just layers and layers and layers on why the UK is just really poor. I think one of the things is because London was really a dominant financial capital at one point back in early 2000s, late 90s, I think. And the UK, or the sterling, has been a very stable currency, and it was the world reserve currency at one point. It's very difficult to really give it a knockdown or for it to take a real knock, I think, until it might be too late. That's pure speculation, but that might be sort of how we see this play out, because there are, again, those things stacking up and it's not really reflecting in the price action as far as I'm concerned. Anyway, all of these points here lead to a structurally negative, are structurally negative for sterling flows. Net new equity capital formations is weak, structurally softer sterling demand. So foreign investors buy UK stocks during IPOs. If no companies are listing, foreign money doesn't come in. That removes a major source of the sterling support or the sterling demand. So this is, yeah, again, I keep saying it, it's just problem after problem after problem. So now we've got monetary and fiscal cross currents are tightening the noose. Now, I'm not sure how many of you really pay attention to the UK. And one of the reasons I covered the UK specifically is obviously, as I said at the start of the stream, I talk about the pound and the UK all the time on my regular stream segments. But I also thought that the other stream guests will likely talk about the US quite heavily. So I wanted to take you on a little bit of a different direction today. So I hope you guys actually get some sort of value from this. Where were we? Bank of England balance sheet fell from 50% to roughly 25% of GDP since 2021, among the fastest, or one of the fastest, among the fastest quantitative tightening programs in the G7. Debt services cost 10% or roughly 10% of tax receipts. Fiscal drag offsets monetary easing. Roughly £1 in £10. So like $1 in $10 for the US guys of receipts are spent on interest, basically. Tax rises and spending restraint leave both policy arms restrictive. While the US begins discussing fiscal expansion, the UK faces simultaneous fiscal and monetary drag, a uniquely sterling negative setup. So we can see down here, I'm not sure how well you guys can see this. Hopefully it's good enough for you to see. But this is basically what I was talking about up here. The Bank of England balance sheet has fallen from 50%. We can see that reflected on this graph here. It's just a free fall. Then we've obviously got the budget that came out in the UK. I'm fairly sure that there might be a revision that's coming at some point. I'm not 100% sure, but this is, as it stands right now, I'm like 99% sure. The pound fell to its lowest level against the dollar since April on Tuesday. This was last week. This was taken from Financial Times last week. So this isn't like an old newspaper or whatever. Policy fatigue, minimal domestic stimulus, and a lack of safety for net sterling. Both policy arms are restrictive. The next easing cycle starts from stress, not strength. So if monetary policy is tightening, sorry, 1 second. I've got some notes on my overscreen. I'm just making sure I'm staying on track and covering the right topics. So monetary policy is tightening, higher borrowing costs. Fiscal policy is tight, higher taxes, and less spending. Now, if we've got both of those things together, so if we've got a monetary policy that's tightening and we've got a fiscal policy that's tight, higher taxes, less spending, we're going to see lower growth or slower growth. It's going to be, again, an ugly situation for the UK. So let's move on. What can we start expecting for next year? Well, we've got a couple of different things, and we can really take advantage. If all of this really does start getting reflected on the markets, as I expect it will, we can really capitalize, and there's a couple of different ways we can do it. And this is where sort of the trade ideas start to form. So the base case for 2026, the Bank of England is expected to cut 50 to 75 basis points ahead of the Fed. Fiscal drag keeps growth near zero. Euro pound trend towards 0.895. Path depends on obviously ECB timing. So basically what I'm saying here is I would expect the euro pound to continue its upside path that it's already on, actually. However, the big thing there is obviously the ECB as well as the Bank of England. So base path, fade 1.33 to 1.34. This is about the pound dollar, by the way. So we're looking to fade any strength on pound dollar. Medium term, mean reversions towards 1.27 area if spreads compress to from 0 to 10 basis points, as we spoke about earlier. We would flip neutral if the UK and US 2-year spread rebuilds a 40 to 50 basis point spread, obviously, or if UK wage momentum reaccelerates. Weak growth plus early easing equals a soft sterling into mid-2026. Our anticipation is that the sterling will soften into mid-2026 and rebound only once real yields bottom. By the way, as I said, I want to try and make this educational, not just me talking. I know I've been talking at you for a little bit. Real yields are different from normal yields, or whatever you would just call yields. So basically what real yields are, you take into account the interest rates. So let's say the interest rate, just for example purposes, is 1%. Then you would also take the inflation rate. Let's say, again, perfectly hypothetical, let's just say it's 0.5. That gives us the real rate of 0.5. Do you see what I'm saying? So we take away the inflation basically from the interest rate. And that's a big thing. Something else to note is that in 2025, the US dollar has had one of its worst performances in, I think, over a decade. I'm fairly sure that's the start. It's been a terrible, terrible year for the dollar. I think we all have experienced that. However, the sterling still underperformed. And when I say underperformed, obviously it underperformed relative to what? But if we just look at this is the weekly, the weekly currency index. So we've got the Swiss, we've got, I think, the euro, the dollar, the pound, and the, I think, Canadian dollar down there. The pound has done really nothing in terms of strength. So that's just one of those other things that I wanted to mention. Now, how can we take advantage of this information? Well, I don't trade stocks. I want to make this perfectly clear. I am not a stock trader. I don't really know much about stocks. This is just from my own research. So if you guys want to do whatever you want to do, cool. Again, as I've listed here, this is not investment advice. It's not trade advice. It's not financial advice. So we've spoken about a weak pound. What can we look for if we've got a weak currency? Well, we can look to the stock market. In this case, specifically, a basket of exporters, actually a basket of FTSE exporters. So UK 100 companies earn roughly 70 to 80% of revenues abroad. With 70 to 80% of ex-UK revenues or export UK revenues, FTSE 100 EPS translates favorably when GBP weakens. A weaker GBP or weaker sterling lifts earnings for exporters, which would be AstraZeneca. We've got Shell. We've got Diageo. I don't think I've heard of that company. Unilever and BP. So macro expression: short GBP, long FTSE export basket. This is a defensive pair. A weaker GBP or weaker sterling historically supports FTSE performance during early easing cycles. Okay. Again, important to highlight that early easing cycles, this could be played. So again, you would need to pay attention to what the Bank of England is doing, when they are doing it, and then you'd need to execute it very accurately. Again, whatever you do with this is your decision. Maybe some sort of options play could be something, but I don't trade options. I don't really know how to do them. So I'm not going to go into sort of execution methods and things on this. So again, just to quickly recap, I think one of the best ways to capitalize from a weakening sterling in this specific situation is buying exporters, FTSE exporters specifically. Now we're coming back to FX now, because again, I don't trade stocks. I don't know how many of you guys trade stocks, but anyway, yeah, FX is my bread and butter. That's what I love. So trade summary. This is the base case as of November 2025. Now, I just want to clarify that I made this presentation, I think, a week and a half ago, roughly. So if anything has been slightly off or I've missed a data point, it's probably because it came out after I made the presentation. Anyway, base case as of November 2025, Bank of England cuts before the Fed, ECB later. We reassess weekly on spreads, services, CPI, and OIS curve. So what I'm saying there basically is that we are expecting, obviously, as I've already mentioned before, the Bank of England should, or when I say should, I mean should in terms of what I'm thinking, cut before the Fed and also cut before the ECB. We are going to reassess all of the data weekly, including the spreads that we've already mentioned, inflation, and the OIS curve. So every week, again, we're going to basically just sit down, look at the data. Is this still a valid trade idea in terms of shorting sterling, buying exporters? So we can basically exploit this idea in a few different ways, and you can see the themes listed down here. So we've got monetary policy divergence, and again, this would be shorting pound dollar. So we'd be looking for the Bank of England to cut before the Fed. UK and US 2-year spread compresses. Again, we've already mentioned this and covered it earlier. The time horizon on this trade could be 1 to 3 months. So when I say time horizon, it basically means how long we could sit in the trade potentially. The risk is if the Fed ends up cutting sooner than the Bank of England, and that would basically wipe out this trade. So you can see the triggers to flip or reduce. The Fed cuts first, or UK services CPI reaccelerates, step back. If we want to play a tightening theme, then we could look for longs on euro pound. ECB slower to ease than the Bank of England. Again, this could be a 4 to 8 week sort of time horizon or trade idea. The risk would be that the Eurozone surprises dovish, or the ECB flips dovish. Easing, we could receive UK 2-year spreads and steepener. I'm not going to go into that again. You can feel free to screenshot it. I don't trade that. It was just an idea one of my team had, so I put it on there for, again, anyone that might be relevant for. Quantitative easing, we could long FTSE exporters basket, again, as we've just discussed. Sterling weakness boosts EPS, 3 to 6 month time horizon. So this one could be a bit of a longer hold if you are more of a position trader, well, maybe not investor for 6 months, but longer term trader. This could be one for you. Risk would be obviously global risk off. So regardless of what's going on in the fundamentals, if we have something that shocks the market, it could be something like Russia, Ukraine, it could be, another COVID, something that would cause these stocks to sell off, regardless of what we've already discussed. So that's a big thing that we need to pay attention to, obviously, as you normally would anyway, hopefully. So risks and counterpoints. Upside, US soft landing. Could see earlier Fed cuts from that, narrower or a more narrow US dollar advantage. Inflation, energy stocks, revive CPI, delayed Bank of England easing, political wildcard, pro-growth reform, or UK listing incentive reverses structural drag. So the last one here, this political wildcard, although it says wildcard, it's actually quite probable, because in the UK, we've got a lot of political instability. We've got, I think, the petition for an election had, I think it was like 3 million signatures. So the what's the word? The approval rate for the current government that we've got is extremely low. There's been talks of a coup going on in Downing Street as well. So some sort of political wildcard, if you will, is definitely not out of the question. So again, keep your eyes out for something like that, because it wouldn't surprise me. Bearing in mind, we had a conservative government in last year. We went through Boris Johnson, we went through Liz Truss, then we had Rishi Sunak, and that was all in the space of a couple of weeks. So don't write off what could go on there. So connecting the dots. This is just to basically summarize everything we've discussed so far. The UK is slowing, both policies tight, capital outflows are rising. The pound acts as the pressure valve. So if anything goes wrong, we will see it reflected in the sterling. Expect softness through mid-2026 unless yields or wages surprise higher. Best opportunities lie in exporters, steepeners, and tactical shorts. So that basically means you could trade the spreads. We could trade exporters, as we've discussed, FTSE exporters, and of course the sterling shorts. If euro pound breaks and holds above 0.89 on closing basis, we treat GBP weakness as structural and not just tactical. Elite traders positions ahead of the macro curve, not in reaction to it. The message: GBP softness is structural, not cyclical. So I think that covered pretty much everything I wanted to discuss in terms of the sort of economics beyond just what I show you on a daily basis on Edgefinder. Because what we do very often, I'll sit here with you guys on a Wednesday, Thursday, or Friday, and we'll look through this and we'll have a look at the general health of some economies and things. But there are lots of things that go on beyond it. So that's why I wanted to cover it today. Now, another thing I want to point out is that the Edgefinder is actually already reflecting not necessarily the data that I just said about policies and all that type of thing, but we are getting bearish readings on the Edgefinder for the pound, which is nice because that does slightly back up my idea. So now I'm happy to take some questions. I'm going to go over some charts. I think we've got the boring stuff out of the way, if you will, which is obviously all the numbers and things. But yeah, if you've got any questions, let me know. I know that was maybe a little bit quick. I think we did that in about half an hour for 10 slides. I think that was okay. But yeah, feel free to ask questions. That's no problem whatsoever. Okay. Now, we've got a couple of different ways to trade this on an FX side. Again, I'm not going to go into stocks and exporters in terms of charts because I personally have no interest. I think I would be doing you a disservice by probably giving you maybe wrong ideas. Because again, I don't trade them. I don't know the behaviors, that type of thing. So we could be looking for some very basic things like euro pound longs, as we just discussed on the presentation. I think the technicals are very simple actually on euro pound. Now, the market itself can be quite tricky. We discuss euro pound quite regularly, actually, especially on my segments, that it's a very mean reverting pair, meaning that because the because Europe and the UK are so closely related, basically what we see is basically up and down mean reverting behavior, and it's the same thing with things like Aussie, New Zealand. So that can be a little bit of a problem when trying to trade a market like this, because even let's say we want to buy here. Where's the upside? Well, we could maybe buy up until here, but again, where can we really trade this into? So I think the lower we can get in terms of like the lower the price, the better we're going to be. Obviously, I mean that's sort of trading 101. So I'd be probably initially looking for a long position right off this. So this would be a very classic break and retest. That's how I trade on a daily basis, really, is break and retests. So this would be likely my first position into the market. Then obviously we'd be taking a catalyst approach. So what that means is rather than just buying and buying and buying as the market goes up, we could wait for catalysts. So what a catalyst could be is the Bank of England. Let's say we get here, we're in the market. The Bank of England cut rates and they take a super dovish tone. Okay, well, the market's going to spike. Well, maybe not that much, but you get what I'm saying. The market's going to rally up on that. So we would just wait for the next dip and we would buy because we've now got a new catalyst to buy. And same thing, if inflation continues higher or lower, or, again, put it into context with whatever idea you're going for specifically. But we could, again, take that catalyst approach. So I think that's a very sort of sensible and easy idea to do. Now, the other side of that is we've got a hedge, or we could take a hedge. So things like pound dollar, we already discussed shorts on pound dollar. So I'm not going to go through the fundamentals again, but on a technical basis, there are a couple of things here that I do quite like and actually might even look for a short later this week on this level. So what we'd be doing here is obviously buying sterling, selling US dollars. So what we could do if we wanted to really push this idea to its limits by, I don't know, let's say going long on euro pound, we go long on, long euro pound and then short pound dollar. We could then do something like going long on pound yen. So pound yen is interesting. I think Nick spoke about yen actually earlier. I see a few new messages in the chat. I'll take a look in a second. So although I don't like the UK or I don't like the sterling, and I do think there's a bit of a bad time coming, I do think we could see more upside on the pound yen. So this would be a really nice way to just get out of some of that risk. So again, if we are, let me do this. So I tell you guys about this quite often on stream, and it's the way that I measure my exposure. So let's say we are pound dollar short. That makes us -1 on GBP. It makes us +1 on USD. Wait, is that right? Yeah, that's right. Then if we wanted to go, I don't know, let's say euro pound long, that would again make us +1 euro, and then that would make us -1 on GBP. So that then puts our exposure at -2 for GBP. So then what we want to do is, rather than sitting at, I don't know, let's just make it easy and say we took 1% risk on both trades, that puts us at 2% risk on the pound. Okay, fine. But if that goes wrong, then we're losing 2%. That's not good. So what we can do is move to something like pound yen, where yes, I do think we could see upside, and then we can go long pound yen. This then moves our exposure, or changes our exposure on the pound to 1. So now we've got 1% risk on the pound. Obviously, it's not quite that easy because it depends where your stops are and those types of things. But you get what I'm saying, the overall exposure limit. So this would be a nice way to just even out the portfolio slightly. So we could be looking for a break and retest here. I think, again, that's a very simple, easy idea to go for. I'd be looking at that regardless of what the other things I'm doing in my portfolio. So pound Swiss, I'm actually already in a short on pound Swiss. Let me just see if I can pull it up for you, because I didn't take it on trading. I took it on IG. Just bear with me for a second. Again, just a bit of didn't plan for that. Where's it gone here? So, oops. Let me just show you the approach I'm taking so I can explain it properly. Yeah, so pound Swiss, I'm already in a short. It's very, very small. So you can see I'm only in a 0.05 position. Basically, what I'm doing on pound Swiss is I'm layering or DCA positions. So rather than just going in for a entry here, stop loss here, I'm actually going to sell. Well, I've already sold here. I plan to sell again if we can reach the 61.8 or the 0.618. And then I'll just keep selling as we go higher. Now, again, it's kind of a twofold trade. It's partly because we've got the edge finder reading bearish on pound Swiss here. And obviously, as I've already mentioned, I am bearish on the pound. So it's a twofold trade, really. This is good game, James. Thanks. No problem at all. Don't know if anyone's alive. Yeah, I mean, it's expected. This is going to be a smaller stream than normal, isn't it? Bad trade swaps will kill you. Pound yen. Well, swaps, yeah. I mean, it's a rough one because yes, swaps are negative for my position. So if I'm, let me pull it up on here just for ease. So actually, let me show you on the edge finder as well. Carry trade here. So pound Swiss is actually the best currency to buy in terms of the swaps right now. So what we're looking at is the interest rate in the UK, which is 4%. The interest rate in Switzerland or the S&B is 0. So if I'm selling, which is what I am doing, I am losing money on this. Now I'm fine with that because obviously the profit, or the expected profit will obviously be more than the swaps, what I paid. So it's fine, but yes, it will eat into the profit. So it's something to keep in mind. So if you are going in for a position, let's say you're going in like this, what you might want to do is keep the swaps in mind. So actually, let's just make it easy and say we went here, just so I can visualize it for you. Rather than trailing stops, normally, I don't know how you do it. Maybe you do it behind, structure or percent wise. I don't know. I don't care. But you would also, again, account for the swaps. So rather than moving to break even, because this is not your true break even, obviously, if you're paying swaps, your true break even might be here. So then account for that, because if your trailing stops get taken out here, great, you're basically at true break even because you've covered the minor profit here, covered the swaps you paid. Whereas if you actually get taken out of what you think is break even here, then you're going to lose the swaps. So you've actually lost your trade. Does that make sense? Not really part of the stream. Sorry, not really part of the webinar I was planning, but I suppose it kind of fits in there. Yes, there is the intervention risk with the yen, absolutely. So that's something to also keep in mind. I don't think we're going to get the intervention as soon as I was thinking, to be perfectly honest with you. So in terms of interventions with the MOF, I think it might be closer to 160. I hate to say that because I was sitting here for a good amount of time saying I really don't think that pound dollar can get to 160. I would be slightly surprised if it does, but also it wouldn't be a massive shock. Do you know what I mean? I kind of expect it, but it would be a bit disappointing. Yen is fundamentally weak and will only worsen. Yeah, that's pretty much it. So that's why, yeah, pound yen long. euro pound long, and then pound dollar, pound Swiss shorts, keeping it very simple. Mustache looks cool. Thank you very much. Free ad for Huel. I don't do free advertising. Maybe we should put some sellotape over that, or duct tape. Okay, so in terms of FTSE, I said I wouldn't go into stocks, so I'm not going to go into individual stocks. FTSE, however, could continue higher if we do get those Bank of England rate cuts sooner than the Fed. I think we could look for something very, very basic. Again, this is sort of short-term thinking. The Bank of England isn't going to cut between the current price and my entry price here, but we could take the position anticipating that. Now, as fundamental traders, I actually made a video on this, a reel on it, I think last week. But as fundamental traders, you have to be able to predict. Now, what you'll hear very, very commonly within retail trading is, oh, you need to react, never predict. Don't predict, that's for gambling. That's the wrong way of thinking. You have to be able to predict, because what we're doing isn't actually predicting, we are forecasting. We're making educated guesses and educated bets on what we think a central bank or a data release will be based on other data points. Does that make sense? So although, yes, the Bank of England isn't going to cut between now and then, we can, again, take that trade in anticipation for that to happen. So again, I want to clarify, I'm not taking this exact trade. I'm not telling you to take this exact trade. It's just, I'm sort of visualizing and showing you ideas. So pound CAD could also be a good one. I think, was it Marco that spoke about pound CAD? I'm not 100% sure. I think he did. So pound CAD could be quite a nice one to go short. Now, this one's a little bit mixed because Canada's fundamentals are quite weak. However, I think there's an opportunity to be short pound CAD. I'm fairly sure it's on the Edge Finder as well. Right here. Yeah. So we got a score of -6. Nothing too great. I will stick with pound Swiss shorts for now. But yeah, to be honest, that kind of covers everything I wanted to discuss. I got through it a lot quicker than I thought it would, actually. But let me just double check I'm not forgetting or missing anything at all. So no, I don't think I am. It's all very basic. So again, just to quickly recap, the fundamentals for the UK, not great, but I've not looked at the heat map. So let's take a quick look at the UK economic heat map. So it's currently sitting at 50. So what we need to obviously remember with the heat map is it's using the surprise here, not necessarily just the actual and the previous. However, I would expect this to potentially get worse as we continue to get worse data out of the UK. So what or if you're in the UK, you'll completely understand. But the situation in the UK, it's not just a fact of, oh, inflation's high and we've got low growth. That's kind of just the baseline of it. It goes much, much further, and we've got problems such as, there's what over here is called the cost of living. I'm not sure if that's in any of your countries, but the cost of living basically is just a situation where the cost of food over here is astronomical. So for example, I went to the shop yesterday. I did I got some bacon, some sausages, some fruit, a bit of veg, and some bread. I think that was it. It was like a Victorian child's shopping. It was like £45. I was like, what the like, how has that happened? And it's just the situation in the UK for just the average person it's becoming unlivable. And again, as a citizen here, as a resident here, I feel it on a day-to-day basis. But again, the markets are kind of different from day-to-day life. So I can anticipate, I can sit here and say, this has been my experience. This is my experience in the UK. And this is what I feel living in the UK. Now it's just a case of waiting for the markets to catch up. And that's why actually you'll see quite often, if you look at any institutional research and they're talking about a specific area, whether it be Japan or the UK or America, normally, not every time, but normally they will have someone from that place doing the analysis and talking about that location. And that's because they're better at putting it into context, and they can sort of relate to it and forecast it better because they know the sort of inner workings, if that makes sense. How do you plan to trade pound? How do you plan to trade the pound on CPI on Wednesday? I don't think I will. I won't be actively. I don't really actively trade news anyway. If I've got positions open, I will hold them and If they hit stops, they hit stops. If they don't, great. But yeah, I never trade news directly. So, for example, the pound Swiss position I'm in, which is basically just DCA, it's no problem for me. If it goes higher, I'll add in. If it goes lower, fine, great, I'm in profit. But yeah, I don't trade news itself or news releases. So I'm just thinking if there's any other ways we could express the idea. And I don't really think there is. Again, we've got the FTSE, we've got the FTSE exporters, we've got the pound. We can go long and short pound via euro pound longs and pound yen shorts. Pound yen longs and euro pound longs and pound dollar shorts. Sorry, I got mixed up there. a lot of talking. So again, I'm going to ask one more time if there's any questions. If not, I might end my segment 10 minutes early just because I don't really have anything else to discuss with you guys. I think the webinar is going to be recorded and sent out to people because obviously you guys put your emails in. I'm fairly sure you'll get an email with a link to it. So if you want to rewatch it, you can. I'm not sure about the presentations. I'm not sure if they're getting sent out or not. If not, feel free to message me. I'll send you my segment anyway. It's not a problem. But yeah, in terms of what to watch, so again, Bank of England, make sure you watch not just their decision. You need to pay attention to the forward guidance, which is a statement and press conference. Obviously, I'm talking that's tailored to the US, but you get what I'm saying. And inflation. We also want to watch the jobs market or jobs data. So there's a couple of different things you need to pay attention to with the UK because what you will notice is with trading, a lot of things are orientated to US. So when you're watching YouTubers or you're talking about news, oftentimes it'll be, again, tailored towards US. It'll be the Fed, it'll be NFP. The UK doesn't have that. So you need to, again, make sure you're understanding the data that's coming out of the UK and you're able to put it into context. It's not massively different, by the way. I'm not trying to say that in terms of you've got to learn a whole new set of economics. It's definitely not that. But again, it's just understanding the terms. So, for example, again, we don't have NFP in the UK. I agree. UK gone to, was back last year and was shocked about how much it's gone downhill. It's terrible. It's really bad. Why buy UK? Why buy? Oh yeah, UK 100 if economy's hurting. So I'll just quickly take you back here. So we're not buying the FTSE itself. We're buying the exporters of the FTSE. I'm going to leave this on screen for a second while I read the other messages. UK becoming a third world country. Yes, absolutely it is. The thing is, it feels a little bit embarrassing to sit here and say that because I feel like I'm trying to call the end of an empire because, the UK has been a massive, well, it was an empire at one point. And as I said, it used to be a reserve currency. We were a dominant player in the financial markets at one point as well. So now I'm sitting here saying that short the UK. It feels a bit silly, but someone's got to do it, and it's going to be me. But yeah, no, it's terrible. I mean, look at London, for example. You cannot walk into London with a Rolex or anything. You can't even go with an iPhone because it's just going to get stolen. And if you resist, you're going to end up in hospital. So it's not a good place to live in terms of safety, finances, anything. It's not good. Oh, sorry, Sluggy. I showed you the slide and forgot to actually reply to you. Wait, was it Sluggy that asked that? Yes. So again, FTSE UK 100 companies earn roughly 70 to 80% of their revenues abroad. With 70 to 80%, it basically translates favorably when the pound weakens. A weaker pound lifts earnings for exporters. So there's that, but there's also the fact of if our currency is weaker, it's beneficial for another currency because that means they're effectively paying less. Sorry, hold on. Is that right? Paying less, paying more? I think I might have gone brain dead. Anyway. It was a great country. It changed in the bad way. Yeah. Well, it's one of those things. I think the UK is not gonna end up like a real third world country. I really don't think that. I mean, it's possible, but I would doubt it. I think this is, I think, sort of late 20-teens and 2020s are a bad patch. I'm really hoping that's the case because obviously, it's my home. I don't want it to go down. I don't want a situation where the UK is going to fall apart. But as a trader, I can't sit here and deny the logic, or sorry, deny the data and the facts. It's illogical. Anyway, so what we could do is, I'm just going to slightly go off topic here and go to the US. I know I'm sure people have discussed the US before me, so I'm not going to go into much detail. But with the pound dollar trade, it's tricky because I'm not necessarily overly bullish on the dollar. So I think the best opportunity, and my actual game plan, because I know I said I'm not going to give you financial advice. This isn't financial advice, but I'm going to tell you exactly what I'm going to do. I'm already in DCA short position. Well, already in my first DCA short position on pound Swiss. I'm going to keep that and I'm going to hold it. I'm going to go long euro pound. I'll be honest, I'm not 100% sure when. If we can come down to around 0.87-ish, that will be probably my first execution point with a very, very tightly managed risk and stop. What else was the pound yen? Where's that gone? Pound yen. I will be looking to long pound yen. And now I'm thinking about it a little bit more. I actually think I'm going to go in for a DCA position or a DCA approach on pound yen as well. So rather than going in stop loss, entry, take profit, it will be more like entry. If we come down lower, I'll enter again. And I'll look to take profits probably at 208, really on the dot as we approach this high. So I think that's pretty much my game plan. I might go long on some exporters on my stock portfolio. Very small positions. Again, I don't trade stocks. I don't know enough about them to talk about them too heavily or to put too much money on them. But I might do that as well, just a little bit of a play. So that's my game plan. That's my idea on the pound or on the UK. So next time I'm on stream and I say I don't like the UK, you actually know why. Because I know, again, I sit here quite often and I say, oh, I'll tell you why I don't like the UK. I don't like the UK because of this, and I'll explain it fully in another stream. Today has been that stream. So guys, I'm going to call it a day. Again, it's not been my full hour. I'm calling it about 5 minutes early, but hopefully that's okay. Guys, have a good one. If you do have any questions specifically about what I spoke about, you can message me on Instagram. That's probably the best place to do it. Guys, have a good one. Stay safe. Don't get margin called. I'll see you tomorrow on my normal segment. Have a good one. Enjoy the rest of your days or your evenings, and I'll speak to you very soon.
You've been watching A1 Trading Live. We're here Monday through Friday, where you can tune in to hear insights from professional traders from all over the world. All month long, our products are 40% off, the biggest discount of the entire year. You can get access to our trading softwares, trading community, and so much more right now on our website, a1trading.com. Make sure to subscribe for future streams, and don't forget, if you're looking to get access to free courses, prop firm discounts, and free trading tools, as well as massive discounts on all our products, head over to a1trading.com. See you next time.